1. Introduction to accounting. 1.1 What is accounting? Accounting is the language of business. It is a systematic process of recording, analyzing, interpreting, and communicating financial information about an organization. The primary purpose of accounting is to provide relevant and reliable financial information to stakeholders, such as investors, creditors, managers, and government agencies, to make informed decisions. At its core, accounting involves the measurement, processing, and communication of financial information about economic entities. It encompasses a wide range of activities, including the identification, measurement, and recording of financial transactions, the preparation of financial statements, and the analysis and interpretation of financial data. The role of accounting. Accounting plays a crucial role in the success and sustainability of businesses. It provides a framework for monitoring and evaluating the financial performance and position of an organization. By keeping track of financial transactions and preparing accurate and timely financial statements, accounting helps stakeholders understand the financial health of a company and make informed decisions. Key functions of accounting. 1. Recording financial transactions. One of the fundamental functions of accounting is to record financial transactions. This involves systematically documenting all business activities that involve the exchange of money or other valuable assets. These transactions are recorded in the accounting system using various documents, such as invoices, receipts, and vouchers. 2. Classifying and summarizing financial data. Once the financial transactions are recorded, the next step is to classify and summarize the data. This involves categorizing transactions into different accounts based on their nature, such as assets, liabilities, equity, revenue, and expenses. The summarized data is then used to prepare financial statements and reports. 3. Preparation of financial statements. Financial statements are the end result of the accounting process. They provide a snapshot of a company's financial performance and position at a specific point in time. The three main financial statements are the balance sheet, income statement, and cash flow statement. These statements help stakeholders assess the profitability, liquidity, and solvency of a business. 4. Analysis and interpretation of financial data. Accounting also involves analyzing and interpreting financial data to gain insights into a company's financial performance and make informed decisions. Financial ratios, trend analysis, and comparative analysis are some of the tools used to evaluate the financial health of a business. This analysis helps stakeholders identify strengths, weaknesses, opportunities, and threats and guides them in formulating strategies for growth and profitability. 5. Compliance with legal and regulatory requirements. Accounting is subject to various legal and regulatory requirements. Companies are required to adhere to accounting principles and standards set by regulatory bodies, such as the Financial Accounting Standards Board (FASB) in the United States. Compliance with these standards ensures the accuracy, consistency, and comparability of financial information across different organizations. Branches of accounting. Accounting can be broadly categorized into 4 main branches. 1. Financial accounting. Financial accounting focuses on the preparation and reporting of financial statements for external stakeholders, such as investors, creditors, and regulatory agencies. It follows generally accepted accounting principles (GAAP) and provides an overview of a company's financial performance and position. 2. Managerial accounting. Managerial accounting, also known as cost accounting, is concerned with providing financial information to internal stakeholders, primarily managers and decision-makers within an organization. It involves the analysis of costs, budgets, and performance metrics to support planning, control, and decision-making processes. 3. Auditing. Auditing involves the examination and verification of financial statements and records to ensure their accuracy and compliance with accounting standards. Auditors, who are independent professionals, assess the reliability and integrity of financial information and provide an opinion on the fairness of the statements. 4. Tax accounting. Tax accounting deals with the preparation and filing of tax returns and ensuring compliance with tax laws and regulations. It involves calculating taxable income, determining tax liabilities, and maximizing tax benefits through strategic planning and compliance. Conclusion. Accounting is a vital discipline that provides the foundation for financial decision-making in businesses. It involves the systematic recording, analysis, and communication of financial information to stakeholders. By understanding the basics of accounting, individuals can gain insights into the financial health of organizations and make informed decisions. 1.2 Importance of accounting in business. Accounting plays a crucial role in the success and growth of any business. It provides a systematic way to record, analyze, and communicate financial information, which is essential for making informed business decisions. In this section, we will explore the importance of accounting in business and how it contributes to the overall financial health and stability of an organization. Financial decision-making. One of the primary reasons accounting is important in business is its role in financial decision-making. Accurate and up-to-date financial information allows business owners, managers, and stakeholders to make informed decisions regarding investments, expansion, cost control, and resource allocation. By analyzing financial statements and reports, decision-makers can assess the profitability, liquidity, and solvency of the business, enabling them to make strategic choices that align with the company's goals and objectives. Monitoring and controlling finances. Accounting provides a framework for monitoring and controlling the financial aspects of a business. Through the use of financial statements, such as the balance sheet and income statement, businesses can track their revenues, expenses, assets, and liabilities. This information allows them to identify areas of financial strength and weakness, enabling them to take corrective actions when necessary. By regularly reviewing financial reports, businesses can ensure that they are operating within their budget, managing cash flow effectively, and maintaining financial stability. Compliance with legal and regulatory requirements. Another critical aspect of accounting in business is ensuring compliance with legal and regulatory requirements. Businesses are required to maintain accurate financial records and report their financial performance to various stakeholders, including government agencies, investors, and creditors. Accounting provides the necessary tools and techniques to prepare financial statements in accordance with generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS. Compliance with these standards not only ensures transparency and accountability but also helps businesses build trust and credibility with external parties. Facilitating external communication. Accounting serves as a common language for communicating financial information to external parties. Investors, lenders, suppliers, and other stakeholders rely on financial statements to assess the financial health and performance of a business. By providing accurate and reliable financial information, accounting enables businesses to attract investment, secure loans, negotiate favorable terms with suppliers, and build strong relationships with stakeholders. Additionally, financial statements are often required for tax purposes, audits, and legal proceedings, making accounting an essential component of external communication. Assessing business performance. Accounting allows businesses to assess their performance and measure their success over time. By analyzing financial ratios, such as profitability ratios, liquidity ratios, and solvency ratios, businesses can evaluate their financial performance against industry benchmarks and historical data. This analysis provides insights into the efficiency of operations, profitability of products or services, and overall financial health of the business. By identifying areas of improvement and implementing strategies to enhance performance, businesses can strive for continuous growth and success. Facilitating planning and forecasting. Accounting plays a vital role in the planning and forecasting process of a business. By analyzing historical financial data, businesses can identify trends, patterns, and potential risks or opportunities. This information is crucial for developing realistic budgets, setting financial goals, and making accurate financial projections. Accounting also helps businesses evaluate the financial feasibility of new projects or investments by estimating costs, revenues, and potential returns. Effective planning and forecasting enable businesses to allocate resources efficiently, mitigate risks, and make proactive decisions to achieve their long-term objectives. Supporting business valuation and investment decisions. Accounting information is essential for valuing a business and making investment decisions. Investors and potential buyers rely on financial statements, such as the balance sheet and income statement, to assess the value and potential return on investment of a business. By analyzing financial ratios, cash flow patterns, and other financial indicators, investors can evaluate the financial viability and growth prospects of a business. Accurate accounting information also helps businesses attract investors and secure funding for expansion or strategic initiatives. Enhancing internal controls and risk management. Accounting plays a crucial role in establishing internal controls and managing risks within a business. By implementing proper accounting procedures and systems, businesses can safeguard their assets, prevent fraud, and ensure the accuracy and reliability of financial information. Accounting also helps identify potential risks and vulnerabilities, allowing businesses to develop risk management strategies and implement internal control measures to mitigate these risks. Effective internal controls not only protect the business but also enhance its reputation and credibility in the marketplace. In conclusion, accounting is of paramount importance in business. It provides the necessary tools and techniques to record, analyze, and communicate financial information, enabling businesses to make informed decisions, monitor and control finances, comply with legal requirements, communicate with external parties, assess performance, plan and forecast, value the business, and manage risks effectively. By understanding the importance of accounting and its role in business, entrepreneurs and managers can leverage this valuable tool to drive growth, profitability, and long-term success. 1.3 Types of accounting. Accounting is a broad field that encompasses various types of accounting practices. These different types of accounting serve different purposes and cater to the specific needs of different organizations. In this section, we will explore the main types of accounting and their key characteristics. 1. Financial accounting. Financial accounting is the most common and widely recognized type of accounting. It focuses on the preparation and reporting of financial statements for external users, such as investors, creditors, and regulatory authorities. The primary objective of financial accounting is to provide accurate and reliable financial information about the organization's performance, financial position, and cash flows. Financial accounting follows generally accepted accounting principles (GAAP) and is governed by specific accounting standards, such as the International Financial Reporting Standards (IFRS) or the Generally Accepted Accounting Principles (GAAP) in the United States. These standards ensure consistency and comparability in financial reporting across different organizations. The financial statements prepared under financial accounting include the balance sheet, income statement, statement of cash flows, and statement of retained earnings. These statements provide a comprehensive overview of the organization's financial health and help stakeholders make informed decisions. 2. Managerial accounting. Managerial accounting, also known as management accounting, focuses on providing financial information to internal users, primarily management. The main objective of managerial accounting is to support decision-making, planning, and control within an organization. Unlike financial accounting, which looks at the organization as a whole, managerial accounting focuses on specific departments, projects, or activities. It provides detailed information about costs, revenues, and performance metrics to help managers make informed decisions and allocate resources effectively. Managerial accounting includes various tools and techniques, such as cost-volume profit analysis, budgeting, variance analysis, and performance measurement. These tools enable managers to assess the financial impact of different decisions, evaluate the efficiency of operations, and identify areas for improvement. 3. Tax accounting. Tax accounting deals with the preparation and filing of tax returns and ensuring compliance with tax laws and regulations. It involves calculating the organization's tax liability, applying tax deductions and credits, and maintaining proper documentation for tax purposes. Tax accountants work closely with tax laws and regulations to ensure accurate and timely tax reporting. They stay updated with changes in tax laws and help organizations optimize their tax strategies to minimize tax liabilities while remaining compliant. Tax accounting includes various subfields, such as individual income tax, corporate tax, sales tax, and international tax. Each subfield has its own set of rules and regulations, making tax accounting a specialized area within the accounting profession. 4. Auditing. Auditing is the process of examining and evaluating an organization's financial records, systems, and processes to ensure accuracy, reliability, and compliance with applicable laws and regulations. Auditors, either internal or external, review financial statements, internal controls, and operational procedures to provide an independent assessment of an organization's financial health and integrity. External auditors are typically independent professionals or firms hired by organizations to conduct an external audit. They express an opinion on the fairness and reliability of the financial statements and provide assurance to stakeholders. Internal auditors, on the other hand, are employed by the organization and focus on evaluating internal controls, risk management, and operational efficiency. They provide recommendations for improving processes and mitigating risks. 5. Forensic accounting. Forensic accounting combines accounting, auditing, and investigative skills to detect and prevent financial fraud and misconduct. Forensic accountants analyze financial records, transactions, and other evidence to uncover fraudulent activities, such as embezzlement, money laundering, or securities fraud. Forensic accountants work closely with law enforcement agencies, attorneys, and other professionals to gather evidence, prepare reports, and provide expert testimony in legal proceedings. They play a crucial role in investigating financial crimes and assisting in litigation and dispute resolution. 6. Governmental accounting. Governmental accounting focuses on accounting and financial reporting for government entities, such as federal, state, and local governments, as well as nonprofit organizations. Government accounting follows specific accounting principles and standards tailored to the unique needs and requirements of the public sector. Governmental accounting includes budgeting, fund accounting, and financial reporting for government programs and activities. It aims to provide transparency and accountability in the use of public funds and resources. 7. Nonprofit accounting. Nonprofit accounting deals with accounting and financial reporting for nonprofit organizations, such as charities, foundations, and educational institutions. Nonprofit accounting follows specific accounting principles and standards, such as the Financial Accounting Standards Board (FASB) guidelines for nonprofit organizations. Nonprofit accounting focuses on tracking and reporting on the organization's financial resources, including donations, grants, and program expenses. It aims to provide transparency to donors, stakeholders, and regulatory authorities regarding the organization's financial performance and the impact of its programs. In conclusion, accounting encompasses various types of accounting practices, each serving a specific purpose and catering to the needs of different organizations. Financial accounting focuses on external reporting, managerial accounting supports internal decision-making, tax accounting deals with tax compliance, auditing ensures financial integrity, forensic accounting detects financial fraud, governmental accounting serves the public sector, and nonprofit accounting caters to nonprofit organizations. Understanding these different types of accounting is essential for aspiring accountants and professionals working in the field to effectively meet the diverse accounting needs of organizations. 1.4 Accounting Principles and Standards. Accounting is a systematic process of recording, analyzing, and interpreting financial information to provide useful insights for decision-making. To ensure consistency and reliability in financial reporting, accounting principles and standards have been established. These principles and standards serve as guidelines for accountants and financial professionals to follow when preparing financial statements and reports. Generally Accepted Accounting Principles (GAAP). The Generally Accepted Accounting Principles (GAAP) are a set of accounting principles, standards, and procedures that are widely recognized and accepted in the United States. GAAP provides a framework for financial reporting that ensures consistency, comparability, and transparency in financial statements. These principles are developed and maintained by the Financial Accounting Standards Board (FASB). The GAAP principles are based on 4 fundamental assumptions. Business entity assumption. This assumption states that the business entity is separate from its owners or shareholders. It requires that the financial transactions of the business be recorded separately from the personal transactions of the owners. Going concern assumption. This assumption assumes that the business will continue to operate indefinitely unless there is evidence to the contrary. It allows accountants to prepare financial statements under the assumption that the business will continue to exist in the foreseeable future. Monetary unit assumption. This assumption states that financial transactions should be recorded and reported in a common monetary unit, such as the US dollar. It allows for the comparability of financial information across different time periods and companies. Time period assumption. This assumption divides the life of a business into specific time periods, such as months, quarters, or years. It allows for the systematic recording and reporting of financial information over these time periods. In addition to these fundamental assumptions, GAAP also includes several principles and concepts that guide the preparation of financial statements. These principles include revenue recognition. Revenue should be recognized when it is earned and realized or realizable, and when it can be measured with reasonable certainty. Matching principle. Expenses should be recognized in the same period as the revenues they help generate. This principle ensures that expenses are properly matched with the revenues they contribute to. Conservatism. This principle requires accountants to exercise caution and prudence when making estimates and judgments. It encourages the recognition of potential losses and liabilities, even if they are uncertain. Consistency. Financial statements should be prepared using consistent accounting methods and principles from one period to another. This allows for comparability and trend analysis. Materiality. Financial information should be presented in a way that is relevant and significant to the users of the financial statements. Immaterial items can be aggregated or omitted to avoid unnecessary complexity. International Financial Reporting Standards (IFRS). While GAAP is widely used in the United States, many countries around the world follow the International Financial Reporting Standards (IFRS). IFRS is a set of accounting standards developed by the International Accounting Standards Board (IASB). These standards aim to promote consistency and comparability in financial reporting across different countries and industries. IFRS principles are similar to GAAP principles, but there are some key differences. For example, IFRS allows for more judgment and flexibility in certain areas, such as the valuation of assets and the recognition of revenue. It also places more emphasis on the fair value measurement of assets and liabilities. In recent years, there has been a convergence effort between GAAP and IFRS to reduce the differences between the two sets of standards. This convergence aims to improve the comparability of financial statements across different countries and facilitate global business transactions. Importance of accounting principles and standards. Accounting principles and standards play a crucial role in financial reporting and decision-making. They provide a common language and framework for financial professionals to communicate and analyze financial information. Here are some key reasons why accounting principles and standards are important. Consistency and comparability. By following consistent accounting principles and standards, financial statements can be compared across different time periods and companies. This allows investors, creditors, and other stakeholders to make informed decisions based on reliable and comparable financial information. Transparency and accountability. Accounting principles and standards promote transparency in financial reporting by requiring companies to disclose relevant and reliable information. This transparency enhances the accountability of management and helps prevent fraudulent activities. Investor confidence. Following accounting principles and standards increases investor confidence in the financial statements of a company. Investors are more likely to invest in companies that adhere to recognized accounting principles, as it provides them with a higher level of assurance and trust. Legal and regulatory compliance. Many countries have laws and regulations that require companies to follow specific accounting principles and standards. Compliance with these requirements is essential to avoid legal and regulatory penalties. Global business transactions. With the increasing globalization of business, accounting principles and standards facilitate the comparability and consistency of financial information across different countries. This enables companies to engage in international business transactions more efficiently. In conclusion, accounting principles and standards provide a framework for financial reporting that ensures consistency, comparability, and transparency in financial statements. GAAP and IFRS are two widely recognized sets of accounting standards that guide the preparation of financial statements. Adhering to these principles and standards is essential for accurate financial reporting and informed decision-making in the business world. 2. Financial statements. 2.1 Balance Sheet. The balance sheet is one of the most important financial statements in accounting. It provides a snapshot of a company's financial position at a specific point in time. The balance sheet is also known as the statement of financial position because it presents a summary of a company's assets, liabilities, and shareholders' equity. Components of a balance sheet. A balance sheet is divided into three main sections: assets, liabilities, and shareholders' equity. Let's take a closer look at each of these components. Assets. Assets represent what a company owns and include both current and non-current assets. Current assets are those that are expected to be converted into cash or used up within 1 year, such as cash, accounts receivable, inventory, and prepaid expenses. Non-current assets, on the other hand, are long-term assets that are not expected to be converted into cash within 1 year, such as property, plant, and equipment, intangible assets, and long-term investments. Liabilities. Liabilities represent what a company owes to external parties. Like assets, liabilities are also classified into current and non-current liabilities. Current liabilities are obligations that are expected to be settled within 1 year, such as accounts payable, short-term loans, and accrued expenses. Non-current liabilities are long-term obligations that are not expected to be settled within 1 year, such as long-term loans, bonds payable, and deferred tax liabilities. Shareholders' equity. Shareholders' equity represents the residual interest in the assets of a company after deducting liabilities. It consists of two main components: contributed capital and retained earnings. Contributed capital includes the amount of money or other assets that shareholders have invested in the company, such as common stock and additional paid-in capital. Retained earnings, on the other hand, represent the accumulated profits or losses of the company that have not been distributed to shareholders as dividends. Understanding the balance sheet equation. The balance sheet equation is a fundamental concept in accounting that states assets equals liabilities plus shareholders' equity. This equation reflects the basic principle of double-entry bookkeeping, which ensures that every transaction has an equal effect on both sides of the equation. In other words, the total value of a company's assets must always be equal to the total value of its liabilities and shareholders' equity. Analyzing the balance sheet. The balance sheet provides valuable information about a company's financial health and stability. By analyzing the balance sheet, investors, creditors, and other stakeholders can gain insights into the following aspects. Liquidity. The balance sheet helps assess a company's liquidity, which refers to its ability to meet short-term obligations. By comparing current assets to current liabilities, stakeholders can determine whether a company has enough liquid assets to cover its short-term debts. Solvency. Solvency refers to a company's ability to meet its long-term obligations. By examining the proportion of non-current assets to non-current liabilities, stakeholders can assess whether a company has the resources to fulfill its long-term financial commitments. Financial structure. The balance sheet provides information about a company's financial structure by showing the proportion of debt, liabilities, to equity, shareholders' equity. This helps stakeholders evaluate the company's risk profile and its reliance on debt financing. Working capital. Working capital is a measure of a company's short-term operational liquidity. It is calculated by subtracting current liabilities from current assets. A positive working capital indicates that a company has enough resources to cover its short-term obligations, while a negative working capital may suggest financial difficulties. Asset composition. The balance sheet reveals the composition of a company's assets, allowing stakeholders to assess the quality and value of its assets. For example, a high proportion of cash and marketable securities may indicate strong liquidity, while a significant amount of long-term investments may suggest a focus on long-term growth. Limitations of the balance sheet. While the balance sheet provides valuable information, it has certain limitations that should be considered. Historical snapshot. The balance sheet represents a company's financial position at a specific point in time. It does not reflect changes that occur after the reporting date. Therefore, it is important to consider other financial statements and disclosures to get a complete picture of a company's financial performance and prospects. Subjectivity. The balance sheet relies on management's judgment and estimation, particularly in areas such as the valuation of assets and determination of liabilities. This subjectivity can affect the accuracy and reliability of the reported financial position. Omission of intangible assets. The balance sheet does not always capture the full value of a company's intangible assets, such as intellectual property, brand value, and customer relationships. These assets can be significant contributors to a company's overall value but may not be recognized on the balance sheet. Despite these limitations, the balance sheet remains a crucial tool for understanding a company's financial position and assessing its overall financial health. It provides a foundation for further analysis and decision-making by stakeholders. 2.2 Income Statement. The income statement, also known as the profit and loss statement or statement of earnings, is one of the key financial statements used in accounting. It provides a summary of a company's revenues, expenses, gains, and losses over a specific period of time, typically a month, quarter, or year. The income statement is essential for evaluating a company's financial performance and determining its profitability. Purpose of the income statement. The primary purpose of the income statement is to report the financial results of a company's operations during a specific period. It shows how much revenue the company generated, the expenses it incurred to generate that revenue, and the resulting net income or net loss. The income statement helps stakeholders, such as investors, creditors, and management, assess the company's ability to generate profits and manage expenses effectively. Structure of the income statement. The income statement is structured in a way that allows for the calculation of various financial ratios and metrics. It typically consists of the following sections. Revenue. This section includes all the revenue generated by the company during the specified period. Revenue can come from various sources, such as sales of goods or services, rental income, interest income, and other operating activities. Cost of goods sold (COGS). This section includes the direct costs associated with producing or delivering the company's products or services. It includes expenses such as raw materials, direct labor, and manufacturing overhead. For service-based companies, this section may be replaced with cost of services rendered. Gross profit. Gross profit is calculated by subtracting the cost of goods sold from the revenue. It represents the profit generated from the company's core operations before considering other operating expenses. Operating expenses. This section includes all the expenses incurred in running the day-to-day operations of the business. It typically includes expenses such as salaries and wages, rent, utilities, marketing expenses, and administrative costs. Operating income. Operating income, also known as operating profit or earnings before interest and taxes (EBIT), is calculated by subtracting the operating expenses from the gross profit. It represents the profit generated from the company's core operations before considering interest and taxes. Non-operating income and expenses. This section includes any income or expenses that are not directly related to the company's core operations. It may include items such as interest income, interest expense, gains or losses from the sale of assets, and other non-operating activities. Income before taxes. Income before taxes is calculated by adding or subtracting the non-operating income and expenses from the operating income. It represents the company's profit or loss before considering income taxes. Income taxes. This section includes the income tax expense based on the company's taxable income. The tax rate used is typically the applicable corporate tax rate. Net income. Net income, also known as net profit or earnings, is calculated by subtracting the income taxes from the income before taxes. It represents the company's final profit or loss after considering all expenses and taxes. Importance of the income statement. The income statement is crucial for several reasons. Assessing profitability. The income statement provides valuable insights into a company's profitability. It helps stakeholders determine whether the company is generating sufficient revenue and managing its expenses effectively. Comparing performance. By comparing income statements from different periods, stakeholders can assess the company's performance over time. This allows for trend analysis and helps identify areas of improvement or concern. Decision making. The income statement assists management in making informed decisions. It helps identify areas where costs can be reduced, revenues can be increased, or resources can be allocated more efficiently. Investor evaluation. Investors use the income statement to evaluate a company's financial health and profitability. It helps them assess the company's ability to generate returns and make informed investment decisions. Creditworthiness. Lenders and creditors analyze the income statement to assess a company's ability to repay its debts. They evaluate the company's profitability and cash flow to determine its creditworthiness. Regulatory compliance. The income statement is essential for regulatory compliance. It provides the necessary information for tax reporting, financial statement disclosures, and other legal requirements. Limitations of the income statement. While the income statement is a valuable tool for financial analysis, it does have some limitations. Omission of non-financial information. The income statement focuses solely on financial data and does not provide information about non-financial factors that may impact a company's performance, such as customer satisfaction or employee morale. Subjectivity in expense allocation. Allocating expenses to specific categories can be subjective and may vary between companies. This can make it challenging to compare the financial performance of different companies accurately. Timing of revenue and expense recognition. The income statement records revenues and expenses when they are earned or incurred, not necessarily when cash is received or paid. This can create discrepancies between reported profits and actual cash flow. Lack of future orientation. The income statement reflects past performance and does not provide insights into future prospects. It is essential to consider other financial statements and forecasting techniques for future-oriented analysis. Despite these limitations, the income statement remains a fundamental tool for understanding a company's financial performance and profitability. It provides a snapshot of a company's operations and serves as a basis for decision-making, analysis, and evaluation. 2.3 Statement of Cash Flows. The statement of cash flows is a crucial financial statement that provides valuable information about the cash inflows and outflows of a company during a specific period. It helps users of financial statements, such as investors, creditors, and analysts, to assess the cash-generating ability of a business and its ability to meet its financial obligations. Purpose of the Statement of Cash Flows. The primary purpose of the statement of cash flows is to provide information about the cash flows from three main activities: operating, investing, and financing. By analyzing these cash flows, stakeholders can gain insights into the company's liquidity, solvency, and overall financial health. Operating activities. The operating activities section of the statement of cash flows reports the cash flows resulting from the core operations of the business. It includes cash receipts from customers and cash payments to suppliers, employees, and other operating expenses. This section helps users understand the cash generated or used by the company's day-to-day operations. Positive cash flows from operating activities indicate that the company is generating sufficient cash from its core operations to cover its expenses and invest in growth opportunities. Conversely, negative cash flows from operating activities may suggest that the company is facing challenges in generating enough cash to sustain its operations. Investing activities. The investing activities section of the statement of cash flows focuses on the cash flows related to the acquisition and disposal of long-term assets, such as property, plant, and equipment, as well as investments in other companies. It includes cash inflows from the sale of assets and investments and cash outflows from the purchase of assets and investments. Positive cash flows from investing activities may indicate that the company is selling non-essential assets or making profitable investments. On the other hand, negative cash flows from investing activities may suggest that the company is investing heavily in its future growth or acquiring new assets. Financing activities. The financing activities section of the statement of cash flows reflects the cash flows related to the company's capital structure. It includes cash inflows from issuing debt or equity instruments, such as loans, bonds, or shares, and cash outflows from repaying debt or distributing dividends to shareholders. Positive cash flows from financing activities may indicate that the company is raising capital to fund its operations or expansion plans. Conversely, negative cash flows from financing activities may suggest that the company is repaying debt or returning capital to shareholders. Direct and indirect methods. There are two methods for preparing the statement of cash flows: the direct method and the indirect method. The direct method reports the actual cash inflows and outflows from operating activities, while the indirect method starts with net income and adjusts it for non-cash items and changes in working capital to arrive at the cash flows from operating activities. Although the direct method provides more detailed information about cash flows, it is less commonly used due to its complexity and the additional effort required to prepare it. The indirect method, on the other hand, is more widely used as it starts with the income statement, which is readily available, and adjusts it to derive the cash flows from operating activities. Importance of the statement of cash flows. The statement of cash flows is essential for several reasons. Assessing liquidity. By analyzing the cash flows from operating activities, stakeholders can evaluate a company's ability to generate cash to meet its short-term obligations. It helps determine if a company has enough cash on hand to cover its day-to-day expenses. Evaluating solvency. The statement of cash flows provides insights into a company's long-term financial health by examining the cash flows from investing and financing activities. It helps assess whether a company has the necessary cash resources to repay its long-term debts and fund its growth initiatives. Identifying cash flow trends. By comparing the statement of cash flows over multiple periods, stakeholders can identify trends in cash flows and assess the company's ability to generate consistent cash flows. It helps in making informed decisions about investing or lending to the company. Supplementing other financial statements. The statement of cash flows complements the balance sheet and income statement by providing additional information about the cash flows of a company. It helps users gain a comprehensive understanding of the company's financial performance and position. In conclusion, the statement of cash flows is a vital financial statement that provides valuable insights into a company's cash inflows and outflows. It helps stakeholders assess a company's liquidity, solvency, and overall financial health. By analyzing the cash flows from operating, investing, and financing activities, users can make informed decisions about investing in or lending to a company. 2.4 Statement of Retained Earnings. The statement of retained earnings is a financial statement that provides information about the changes in a company's retained earnings over a specific period of time. It is an important component of the financial statements and is closely linked to the income statement and the balance sheet. Purpose of the statement of retained earnings. The primary purpose of the statement of retained earnings is to show how a company's retained earnings have changed during a given period. Retained earnings represent the accumulated profits or losses of a company that have not been distributed to shareholders as dividends. This statement helps stakeholders understand how the company has utilized its profits or losses and how it has affected the overall financial position of the company. Components of the statement of retained earnings. The statement of retained earnings typically includes the following components. Beginning retained earnings. This represents the balance of retained earnings at the beginning of the period. It is carried forward from the previous accounting period. Net income or net loss. This represents the company's profit or loss for the period. Net income increases retained earnings, while net loss decreases retained earnings. Dividends. Dividends are the distributions of profits to shareholders. Dividends reduce retained earnings. If dividends are not declared or paid during the period, this component will be zero. Other adjustments. This component includes any other adjustments that affect retained earnings but are not directly related to net income or dividends. Examples of such adjustments include changes in accounting policies, corrections of prior period errors, or revaluation of assets. Ending retained earnings. This is the final balance of retained earnings at the end of the period. It is calculated by adding the net income or subtracting the net loss, deducting dividends, and considering any other adjustments. Preparation of the statement of retained earnings. The statement of retained earnings is prepared using information from the income statement, balance sheet, and other relevant financial records. The following steps are typically followed in preparing the statement. Determine the beginning retained earnings balance. This is obtained from the previous period's statement of retained earnings. Calculate the net income or net loss. This is derived from the income statement for the period. Deduct dividends. If dividends were declared and paid during the period, they are subtracted from the net income. If no dividends were paid, this component will be zero. Consider other adjustments. Any other adjustments that affect retained earnings, such as changes in accounting policies or corrections of errors, are taken into account. Calculate the ending retained earnings balance. This is obtained by adding the net income or subtracting the net loss, deducting dividends, and considering any other adjustments. Present the statement. The statement of retained earnings is typically presented as a separate statement alongside the income statement, balance sheet, and cash flow statement. Importance of the statement of retained earnings. The statement of retained earnings is important for several reasons. Assessing profitability. By analyzing the changes in retained earnings over time, stakeholders can evaluate the profitability of a company. Positive retained earnings indicate that the company is generating profits, while negative retained earnings may suggest financial difficulties. Understanding dividend policy. The statement of retained earnings provides information about the dividends paid by the company. This helps shareholders and potential investors understand the company's dividend policy and its impact on retained earnings. Evaluating financial stability. Retained earnings represent the portion of a company's profits that is reinvested in the business. By examining the changes in retained earnings, stakeholders can assess the financial stability and long-term growth potential of the company. Compliance with accounting standards. The statement of retained earnings is a requirement under generally accepted accounting principles (GAAP) and International Financial Reporting Standards (IFRS). It ensures that companies provide transparent and accurate information about their retained earnings to stakeholders. In conclusion, the statement of retained earnings is a crucial financial statement that provides insights into a company's profitability, dividend policy, financial stability, and compliance with accounting standards. It helps stakeholders understand how a company has utilized its profits or losses and how it has impacted the overall financial position of the company. 3. Recording financial transactions. 3.1 Double Entry Accounting. Double entry accounting is the fundamental system used by businesses to record financial transactions. It is based on the principle that every transaction has two sides, known as debit and credit, which must be equal. This system provides a comprehensive and accurate way to track the financial activities of a business and ensures that the accounting equation remains in balance. The accounting equation. Before delving into the intricacies of double entry accounting, it is essential to understand the accounting equation. The accounting equation is the foundation of all financial transactions and represents the relationship between a company's assets, liabilities, and equity. The equation is as follows. Assets equals liabilities plus equity. Assets are the resources owned by a business, such as cash, inventory, equipment, and accounts receivable. Liabilities are the obligations of a business, including loans, accounts payable, and accrued expenses. Equity represents the owner's interest in the business and is calculated by subtracting liabilities from assets. The basics of double entry accounting. Double entry accounting follows a simple yet powerful concept. For every debit, there must be an equal credit. This means that every transaction affects at least two accounts, with one account debited and another credited. The total debits must always equal the total credits, ensuring that the accounting equation remains balanced. To illustrate this concept, let's consider a simple example. Suppose a business purchases inventory worth $1,000 on credit. In this case, the inventory account will be debited by $1,000, representing an increase in assets. Simultaneously, the accounts payable account will be credited by $1,000, representing an increase in liabilities. This transaction maintains the balance of the accounting equation. Debits and credits. In double entry accounting, debits and credits are used to record the increases and decreases in accounts. Understanding the rules for debits and credits is crucial for accurately recording transactions. The general rule is as follows. Debits increase assets and expenses while decreasing liabilities, equity, and revenues. Credits increase liabilities, equity, and revenues while decreasing assets and expenses. To provide a clearer understanding, here are some examples. Debiting the cash account increases the amount of cash on hand. Crediting the accounts payable account increases the amount owed to suppliers. Debiting the revenue account increases the company's income. Crediting the expense account increases the company's expenses. It is important to note that the rules for debits and credits can vary depending on the account type and the accounting system used. However, the fundamental principle of maintaining balance remains the same. T accounts. T accounts are a visual representation of the double entry accounting system. They provide a clear and organized way to record and track transactions. T accounts are named after their shape, which resembles the letter T. The left side of the T represents debits, while the right side represents credits. Each account has its own T account, which shows the balance and the changes made to the account. Debits are recorded on the left side of the T account, while credits are recorded on the right side. The balance of the account is calculated by subtracting the total credits from the total debits. T accounts are particularly useful when analyzing the impact of transactions on specific accounts and when preparing financial statements. Advantages of double entry accounting. Double entry accounting offers several advantages for businesses. Accuracy. By requiring every transaction to have equal debits and credits, double entry accounting minimizes the risk of errors and ensures accurate financial records. Completeness. Double entry accounting captures all financial transactions, providing a comprehensive record of a company's activities. Transparency. The use of debits and credits in double entry accounting allows for easy identification and tracking of the impact of transactions on specific accounts. Financial analysis. Double entry accounting provides the necessary data to generate financial statements and perform in-depth financial analysis, enabling businesses to make informed decisions. Audit trail. The systematic nature of double entry accounting creates a clear audit trail, making it easier to trace and verify transactions. Conclusion. Double entry accounting is the backbone of modern financial record keeping. It ensures accuracy, completeness, and transparency in tracking a company's financial transactions. By following the principles of debits and credits, businesses can maintain the balance of the accounting equation and generate reliable financial statements. Understanding the fundamentals of double entry accounting is essential for anyone involved in financial management or accounting, as it forms the basis for more advanced accounting concepts and techniques. 3.2 Chart of Accounts. The chart of accounts is a fundamental tool in accounting that helps organize and categorize financial transactions within a business. It provides a systematic way to record and track the various types of financial activities that occur within an organization. The chart of accounts is essentially a list of all the accounts used by a company to record its financial transactions. Purpose of the chart of accounts. The primary purpose of the chart of accounts is to provide a standardized framework for recording financial transactions. It ensures consistency and accuracy in the accounting process by establishing a uniform structure for categorizing and classifying different types of transactions. The chart of accounts serves as a roadmap for accountants and financial professionals, enabling them to easily locate and record transactions in the appropriate accounts. Structure of the chart of accounts. The chart of accounts typically consists of a numerical or alphanumeric coding system that assigns a unique identifier to each account. This coding system allows for easy identification and sorting of accounts based on their nature and purpose. The structure of the chart of accounts may vary depending on the size and complexity of the organization, but it generally follows a hierarchical format. At the highest level, the chart of accounts is divided into several main categories, such as assets, liabilities, equity, revenue, and expenses. These main categories are further subdivided into subcategories and individual accounts. For example, under the assets category, there may be subcategories for cash, accounts receivable, inventory, and fixed assets. Each of these subcategories will have specific accounts assigned to them, such as cash on hand, accounts receivable from customers, and property and equipment. Types of accounts in the chart of accounts. The chart of accounts includes various types of accounts that capture different aspects of a company's financial transactions. Here are some common types of accounts found in the chart of accounts. Asset accounts. These accounts represent the resources owned by the company, such as cash, accounts receivable, inventory, and property. Asset accounts are typically classified as current assets or long-term assets. Liability accounts. These accounts represent the company's obligations or debts, such as accounts payable, loans payable, and accrued expenses. Liability accounts are categorized as current liabilities or long-term liabilities. Equity accounts. These accounts represent the ownership interest in the company, including common stock, retained earnings, and dividends. Revenue accounts. These accounts record the income generated by the company from its primary business activities, such as sales revenue, service revenue, and interest income. Expense accounts. These accounts capture the costs incurred by the company in its day-to-day operations, such as salaries and wages, rent, utilities, and advertising expenses. Contra accounts. These accounts are used to offset the balance of another related account. For example, a contra account called allowance for doubtful accounts is used to reduce the balance of the accounts receivable account. Importance of a well-designed chart of accounts. A well-designed chart of accounts is crucial for accurate financial reporting and analysis. Here are some reasons why a well-structured chart of accounts is important. Consistency. A standardized chart of accounts ensures consistency in recording financial transactions across different periods and departments within the organization. This consistency allows for meaningful comparisons and analysis of financial data. Efficiency. A well-organized chart of accounts makes it easier and more efficient to record and retrieve financial information. It provides a clear framework for accountants to follow, reducing the chances of errors and misclassifications. Reporting and analysis. The chart of accounts forms the foundation for generating financial statements and reports. It enables the aggregation and categorization of financial data, making it easier to analyze and interpret the company's financial performance. Compliance. A well-designed chart of accounts ensures compliance with accounting standards and regulations. It facilitates accurate and transparent financial reporting, which is essential for meeting legal and regulatory requirements. Scalability. A properly structured chart of accounts allows for scalability as the business grows. It can accommodate new accounts and categories without disrupting the overall structure and organization of the financial records. Designing a chart of accounts. Designing an effective chart of accounts requires careful consideration of the organization's specific needs and requirements. Here are some key steps to follow when designing a chart of accounts. Identify the main categories. Start by identifying the main categories that are relevant to the organization's financial transactions, such as assets, liabilities, equity, revenue, and expenses. Subdivide the main categories. Divide each main category into relevant subcategories based on the nature of the accounts. For example, under the assets category, you may have subcategories for cash, accounts receivable, and inventory. Assign account codes. Assign unique codes or numbers to each account to facilitate easy identification and sorting. The coding system should be logical and consistent, allowing for easy expansion and modification in the future. Consider reporting needs. Take into account the reporting requirements of the organization when designing the chart of accounts. Ensure that the structure allows for the generation of meaningful financial statements and reports. Review and refine. Regularly review and refine the chart of accounts to ensure its relevance and accuracy. As the business evolves, certain accounts may become obsolete or new accounts may need to be added. By following these steps and considering the specific needs of the organization, a well-designed chart of accounts can be created to effectively capture and organize financial transactions. This will ultimately contribute to accurate financial reporting, informed decision-making, and the overall success of the business. 3.3 Journal Entries. In the previous sections, we discussed the concept of double entry accounting and the importance of maintaining a chart of accounts. Now, let's dive deeper into the process of recording financial transactions through journal entries. What are journal entries? Journal entries are the foundation of the accounting system. They are the first step in the recording process and provide a chronological record of all financial transactions. A journal entry is a formal accounting entry that includes the date, accounts affected, and the corresponding debit and credit amounts. Purpose of journal entries. The primary purpose of journal entries is to maintain an accurate and complete record of all financial transactions. They serve as a source document for posting entries to the general ledger and are essential for preparing financial statements, analyzing business performance, and ensuring compliance with accounting principles and standards. Components of a journal entry. A journal entry consists of several key components. Date, the date on which the transaction occurred. It is important to record the correct date to maintain an accurate chronological order of transactions. Accounts, the accounts affected by the transaction. Each journal entry must include at least two accounts, one account to be debited and another to be credited. The accounts chosen depend on the nature of the transaction and the accounting equation, assets equals liabilities plus equity. Debit and credit, the amounts to be debited and credited to the respective accounts. Debits are recorded on the left side of the entry, while credits are recorded on the right side. The total debits must always equal the total credits to maintain the balance of the accounting equation. Description, a brief description of the transaction. This helps provide clarity and context to the entry, making it easier to understand and interpret in the future. Recording journal entries. To record a journal entry, follow these steps. Identify the transaction. Determine the nature of the transaction and the accounts affected. For example, if a company purchases inventory on credit, the accounts affected would be inventory and accounts payable. Determine the debit and credit. Decide which account should be debited and which should be credited based on the rules of double entry accounting. In our example, inventory would be debited to increase the asset, and accounts payable would be credited to increase the liability. Assign amounts. Determine the amounts to be debited and credited. The amounts should be based on the specific transaction and the accounting equation. In our example, the debit amount would be the cost of the inventory, and the credit amount would be the same. Write the journal entry. Record the journal entry in the general journal or a computerized accounting system. Include the date, accounts, debit and credit amounts, and a brief description of the transaction. Be sure to follow the proper format and maintain accuracy. Example of journal entries. Let's look at a few examples of journal entries to illustrate how they are recorded. Cash sale. A company sells merchandise for cash. Date, January 1st 20XX accounts. Debit, cash credit, sales revenue. Description, recorded cash sales for the day. Purchase on credit, a company purchases inventory on credit. Date, January 5th 20XX accounts. Debit, inventory credit, accounts payable. Description, recorded the purchase of inventory on credit. Payment of expenses, a company pays rent expense in cash. Date, January 10th 20XX accounts. Debit, rent expense credit, cash. Description, recorded the payment of rent expense. These examples demonstrate the basic structure of journal entries and how they are used to record various types of transactions. Importance of accurate journal entries. Accurate journal entries are crucial for maintaining the integrity of the accounting system. They provide a clear and complete record of all financial transactions, ensuring that the financial statements reflect the true financial position and performance of the business. Errors in journal entries can lead to misstatements in the financial statements, which can have serious consequences. It is essential to double-check the accuracy of journal entries and reconcile them with supporting documentation to minimize errors and discrepancies. By mastering the art of recording journal entries accurately, accountants can ensure the reliability and usefulness of financial information, enabling businesses to make informed decisions and comply with regulatory requirements. 3.4 General Ledger. The general ledger is a fundamental component of the accounting system. It serves as the central repository for all financial transactions and provides a comprehensive record of a company's financial activities. In this section, we will explore the purpose and structure of the general ledger, as well as its role in the accounting process. Purpose of the general ledger. The general ledger is a book or electronic record that contains all the accounts used by a company to record its financial transactions. It serves as a permanent and organized record of all the debits and credits for each account, allowing for the preparation of accurate financial statements and analysis of a company's financial position. The primary purpose of the general ledger is to provide a detailed and chronological record of all financial transactions. It allows for the tracking of individual accounts, such as cash, accounts receivable, accounts payable, and various expense and revenue accounts. By recording transactions in the general ledger, companies can ensure that their financial records are complete, accurate, and in compliance with accounting principles and standards. Structure of the general ledger. The general ledger is organized in a structured manner to facilitate the recording and retrieval of financial information. It typically consists of multiple accounts, each representing a specific category of financial transactions. These accounts are classified into different types, such as assets, liabilities, equity, revenue, and expenses. Each account in the general ledger has a unique account number or code, which helps in identifying and categorizing transactions. The account number provides a systematic way of organizing and referencing financial information, making it easier to locate specific transactions or account balances. Recording transactions in the general ledger. When a financial transaction occurs, it is initially recorded in the journal as a journal entry. The journal entry includes the date, description, and amounts of the transaction, as well as the accounts affected. These journal entries are then transferred to the general ledger, where they are posted to the respective accounts. Posting to the general ledger involves updating the account balances by recording the debits and credits associated with each transaction. Debits increase asset and expense accounts, while credits increase liability, equity, and revenue accounts. The general ledger provides a running balance for each account, reflecting the cumulative effect of all transactions. Subsidiary ledgers and control accounts. In some cases, companies maintain subsidiary ledgers in addition to the general ledger. Subsidiary ledgers provide more detailed information for specific accounts, such as accounts receivable or accounts payable. These subsidiary ledgers are linked to the general ledger through control accounts. Control accounts summarize the balances of the subsidiary ledgers and are used to ensure that the total balances in the subsidiary ledgers match the corresponding control account balances in the general ledger. This reconciliation process helps in identifying any discrepancies or errors in the subsidiary ledgers. Trial balance and financial statements. The general ledger plays a crucial role in the preparation of the trial balance and financial statements. The trial balance is a summary of all the account balances in the general ledger, listing the total debits and credits for each account. It serves as a preliminary check to ensure that the debits and credits are equal, indicating that the accounting equation is in balance. Based on the information in the general ledger and trial balance, companies can prepare various financial statements, such as the balance sheet, income statement, statement of cash flows, and statement of retained earnings. These financial statements provide a comprehensive view of a company's financial performance, position, and cash flows. Importance of accurate general ledger. Maintaining an accurate general ledger is essential for several reasons. Firstly, it ensures compliance with accounting principles and standards, providing reliable and transparent financial information. This information is crucial for decision-making by management, investors, creditors, and other stakeholders. Secondly, an accurate general ledger enables the preparation of timely and accurate financial statements. These statements are used by external parties, such as investors and lenders, to assess a company's financial health and make informed decisions. They also serve as a basis for tax reporting and compliance with regulatory requirements. Lastly, the general ledger serves as a historical record of a company's financial transactions. It provides a comprehensive audit trail, allowing for the tracing and verification of transactions. This is particularly important during audits or when resolving discrepancies or disputes. In conclusion, the general ledger is a vital component of the accounting system. It serves as the central repository for all financial transactions, providing a detailed and organized record of a company's financial activities. By accurately recording and maintaining the general ledger, companies can ensure the integrity of their financial records and facilitate the preparation of reliable financial statements. 4. Adjusting entries in the accounting cycle. 4.1 Accrual accounting. Accrual accounting is a fundamental concept in financial accounting that focuses on recognizing and recording financial transactions when they occur, rather than when the cash is received or paid. It is based on the accrual principle, which states that revenues and expenses should be recognized in the accounting period in which they are earned or incurred, regardless of when the cash is received or paid. The basis of accrual accounting. Accrual accounting provides a more accurate representation of a company's financial position and performance by matching revenues with the expenses incurred to generate those revenues. This method allows for a more comprehensive and realistic view of a company's financial health, as it takes into account all economic events that have occurred during a specific period, regardless of the timing of cash flows. Under accrual accounting, revenues are recognized when they are earned, regardless of when the cash is received. For example, if a company provides services to a customer in December but does not receive payment until January, the revenue is still recognized in December because that is when the service was provided. Similarly, expenses are recognized when they are incurred, regardless of when the cash is paid. For instance, if a company purchases inventory in November but pays for it in December, the expense is recognized in November because that is when the inventory was acquired. Accrual accounting versus cash accounting. Accrual accounting differs from cash accounting, which only recognizes revenues and expenses when cash is received or paid. Cash accounting is simpler and easier to understand, as it directly reflects the cash inflows and outflows of a business. However, it may not provide an accurate representation of a company's financial performance and position, especially for businesses that extend credit to customers or have long-term projects. Accrual accounting, on the other hand, provides a more comprehensive and accurate picture of a company's financial activities. It allows for better matching of revenues and expenses, providing a more realistic view of profitability and financial health. By recognizing revenues and expenses when they occur, accrual accounting provides a more accurate assessment of a company's ability to generate profits and manage its resources. The importance of accrual accounting. Accrual accounting is essential for several reasons. Accurate financial reporting. Accrual accounting ensures that financial statements accurately reflect a company's financial position and performance. By recognizing revenues and expenses when they occur, it provides a more realistic view of a company's profitability and financial health. Better decision-making. Accrual accounting provides more reliable information for decision-making. It allows managers to assess the financial impact of their decisions based on the actual revenues and expenses incurred, rather than relying solely on cash flows. Comparability. Accrual accounting enables the comparison of financial statements across different accounting periods. This allows for trend analysis and the identification of patterns and changes in a company's financial performance over time. Compliance with accounting standards. Many accounting standards, such as Generally Accepted Accounting Principles (GAAP) and International Financial Reporting Standards (IFRS), require the use of accrual accounting. Adhering to these standards ensures consistency and transparency in financial reporting. Investor confidence. Accrual accounting provides investors with a more accurate and reliable representation of a company's financial performance and position. This enhances investor confidence and facilitates informed investment decisions. Accrual accounting adjustments. To ensure that financial statements accurately reflect the accrual accounting principle, adjustments are made at the end of each accounting period. These adjustments are known as accruals and deferrals and are necessary to recognize revenues and expenses in the appropriate accounting period. Accruals. Accruals involve recognizing revenues or expenses that have been earned or incurred but have not yet been recorded. For example, if a company provides services to a customer in December but has not yet billed the customer, an accrual is made to recognize the revenue in December. Deferrals. Deferrals involve recognizing revenues or expenses that have been received or paid in advance but have not yet been earned or incurred. For instance, if a company receives payment from a customer in advance for services to be provided in the future, a deferral is made to recognize the revenue when the services are actually provided. Accrual accounting adjustments ensure that financial statements accurately reflect the economic events that have occurred during the accounting period, providing a more accurate representation of a company's financial position and performance. In conclusion, accrual accounting is a fundamental concept in financial accounting that focuses on recognizing and recording financial transactions when they occur, rather than when the cash is received or paid. It provides a more accurate representation of a company's financial position and performance by matching revenues with the expenses incurred to generate those revenues. Accrual accounting is essential for accurate financial reporting, better decision-making, comparability, compliance with accounting standards, and investor confidence. Adjustments in the form of accruals and deferrals are made at the end of each accounting period to ensure that financial statements accurately reflect the accrual accounting principle. 4.2 Prepaid expenses and deferred revenue. In the world of accounting, it is essential to accurately record and report financial transactions. One aspect of this process involves dealing with prepaid expenses and deferred revenue. Prepaid expenses and deferred revenue are both examples of timing differences in accounting, where cash is received or paid before the related expense or revenue is recognized. Prepaid expenses. Prepaid expenses are expenses that have been paid in advance but have not yet been consumed or used up. These expenses are considered assets because they provide future economic benefits to the business. Common examples of prepaid expenses include prepaid rent, prepaid insurance, and prepaid subscriptions. When a business pays for a prepaid expense, it initially records the payment as an asset on its balance sheet. As time passes and the prepaid expense is consumed or used up, the business gradually recognizes the expense on its income statement. This process is known as amortization or allocation of the prepaid expense. For example, let's say a company pays $12,000 in advance for a one-year insurance policy. Initially, the company records the $12,000 payment as a prepaid expense on its balance sheet. Over the course of the year, the company would gradually recognize $1,000 of insurance expense each month on its income statement, reducing the prepaid expense by that amount. It is important to note that prepaid expenses are different from regular expenses. Regular expenses are recognized immediately when incurred, while prepaid expenses are recognized over time as they are consumed. Properly accounting for prepaid expenses ensures that the financial statements accurately reflect the timing of the expense and the related benefits received. Deferred revenue. Deferred revenue, also known as unearned revenue or advance payments, is the opposite of prepaid expenses. It refers to the situation where a business receives cash in advance for goods or services that have not yet been provided. Deferred revenue is considered a liability because the business has an obligation to deliver the goods or services in the future. When a business receives cash for deferred revenue, it initially records the payment as a liability on its balance sheet. As the goods or services are provided, the business gradually recognizes the revenue on its income statement. This process is known as revenue recognition. For example, let's say a company receives $10,000 in advance for a one-year software subscription. Initially, the company records the $10,000 payment as deferred revenue on its balance sheet. Over the course of the year, as the company provides access to the software, it would gradually recognize $833.33 of revenue each month on its income statement, reducing the deferred revenue by that amount. Similar to prepaid expenses, deferred revenue is a timing difference that needs to be properly accounted for to ensure accurate financial reporting. It is crucial for businesses to recognize revenue only when it is earned and to match the revenue with the related expenses incurred in generating that revenue. Impact on financial statements. Both prepaid expenses and deferred revenue have an impact on the financial statements of a business. Prepaid expenses are recorded as assets on the balance sheet, while deferred revenue is recorded as a liability. As the prepaid expenses are consumed or the goods and services are provided, the balance of the prepaid expenses or deferred revenue decreases, and the related expenses or revenue are recognized on the income statement. Properly accounting for prepaid expenses and deferred revenue ensures that the financial statements accurately reflect the financial position and performance of the business. It allows stakeholders, such as investors, creditors, and management, to make informed decisions based on reliable and transparent financial information. Importance of accurate accounting. Accurate accounting of prepaid expenses and deferred revenue is crucial for several reasons. Firstly, it ensures compliance with accounting principles and standards, such as the Generally Accepted Accounting Principles (GAAP) or International Financial Reporting Standards (IFRS). These principles provide guidelines for recording and reporting financial transactions, ensuring consistency and comparability across different businesses and industries. Secondly, accurate accounting of prepaid expenses and deferred revenue helps in budgeting and forecasting. By properly recognizing and allocating these items, businesses can better estimate their future expenses and revenue, allowing for more accurate financial planning. Furthermore, accurate accounting of prepaid expenses and deferred revenue provides transparency to stakeholders. Investors, creditors, and other interested parties rely on financial statements to assess the financial health and performance of a business. Misrepresenting or misreporting prepaid expenses and deferred revenue can lead to misleading financial statements, which can erode trust and confidence in the business. Lastly, accurate accounting of prepaid expenses and deferred revenue helps in tax planning and compliance. Businesses need to properly account for these items to determine their taxable income and fulfill their tax obligations. Failure to accurately report prepaid expenses and deferred revenue can result in penalties and legal consequences. In conclusion, prepaid expenses and deferred revenue are important concepts in accounting that involve timing differences in recognizing expenses and revenue. Properly accounting for these items ensures accurate financial reporting, compliance with accounting principles, and transparency to stakeholders. By understanding and applying the principles of prepaid expenses and deferred revenue, businesses can effectively manage their finances and make informed decisions. 4.3 Accrued expenses and accrued revenue. Accrued expenses and accrued revenue are important concepts in accounting that help ensure accurate financial reporting. These concepts are used to record and recognize expenses and revenue that have been incurred or earned but have not yet been paid or received. Accrued expenses. Accrued expenses are expenses that have been incurred by a company but have not yet been paid. These expenses are recorded in the accounting records to reflect the company's obligations to pay for goods or services that have been received but not yet paid for. Examples of accrued expenses include salaries and wages. If a company's employees have worked for a certain period but have not been paid yet, the company needs to record the accrued expense for the unpaid wages. Utilities. If a company has used utilities such as electricity, water, or gas during a certain period but has not received the bill yet, it needs to record the accrued expense for the utilities used. Interest expense. If a company has borrowed money and the interest payment is due at the end of the month, but the payment has not been made yet, the company needs to record the accrued expense for the interest incurred. Accrued expenses are recorded through an adjusting entry at the end of an accounting period. The adjusting entry increases the expense account and creates a corresponding liability account, such as accrued expenses payable or accrued liabilities. This ensures that the company's financial statements accurately reflect the expenses incurred during the period, even if the payment has not been made. When the payment for the accrued expense is made in the following accounting period, the liability account is reduced, and the cash account is decreased to reflect the payment. Accrued revenue. Accrued revenue is revenue that has been earned by a company but has not yet been received. This occurs when a company provides goods or services to a customer but has not yet received payment for them. Examples of accrued revenue include services rendered. If a company provides services to a customer but has not yet billed the customer or received payment, it needs to record the accrued revenue for the services provided. Rent income. If a company owns rental properties and the rent for a certain period has been earned but not yet received, it needs to record the accrued revenue for the rent earned. Interest income. If a company has invested in financial instruments that generate interest income, and the interest has been earned but not yet received, it needs to record the accrued revenue for the interest earned. Accrued revenue is also recorded through an adjusting entry at the end of an accounting period. The adjusting entry increases a revenue account and creates a corresponding asset account, such as accrued revenue or accounts receivable. This ensures that the company's financial statements accurately reflect the revenue earned during the period, even if the payment has not been received. When the payment for the accrued revenue is received in the following accounting period, the asset account is reduced, and the cash account is increased to reflect the receipt of payment. Importance of accrued expenses and accrued revenue. Accrued expenses and accrued revenue are important for accurate financial reporting and matching expenses with revenue in the appropriate accounting period. By recording these transactions, companies can provide a more accurate picture of their financial position and performance. Accrued expenses and accrued revenue also help in adhering to the accrual basis of accounting, which is the generally accepted accounting principle. The accrual basis of accounting recognizes revenue when it is earned and expenses when they are incurred, regardless of when the cash is received or paid. This provides a more accurate representation of a company's financial activities. Furthermore, by recording accrued expenses and accrued revenue, companies can ensure that their financial statements reflect the true economic impact of transactions. This is particularly important for financial statement users, such as investors and creditors, who rely on accurate and reliable financial information to make informed decisions. Conclusion. Accrued expenses and accrued revenue are essential concepts in accounting that help ensure accurate financial reporting. These concepts allow companies to record and recognize expenses and revenue that have been incurred or earned but have not yet been paid or received. By adhering to the accrual basis of accounting and recording these transactions, companies can provide a more accurate representation of their financial position and performance. 4.4 Closing entries. Closing entries are an essential part of the accounting cycle that helps prepare the books for the next accounting period. These entries are made at the end of the fiscal year to close temporary accounts and transfer their balances to the permanent accounts. The purpose of closing entries is to reset the temporary accounts to zero and start the new accounting period with accurate balances. The purpose of closing entries. Closing entries serve several purposes in the accounting process. The main objectives of closing entries are as follows. Resetting temporary accounts. Temporary accounts, such as revenue, expense, and dividend accounts, are used to track the financial activities of a specific accounting period. These accounts need to be reset to zero at the end of the period to start fresh in the next period. Closing entries transfer the balances of these temporary accounts to the retained earnings account, which is a permanent account. Determining net income or loss. By closing the revenue and expense accounts, closing entries help determine the net income or loss for the accounting period. The net income or loss is calculated by subtracting the total expenses from the total revenues. This information is crucial for evaluating the financial performance of a business and making informed decisions. Maintaining accurate financial statements. Closing entries ensure that the financial statements accurately reflect the financial position of the business at the end of the accounting period. By transferring the balances of temporary accounts to the retained earnings account, the income statement and balance sheet are updated with the correct figures. The closing process. The closing process involves several steps to complete the closing entries. The steps may vary depending on the complexity of the business and the number of accounts involved. However, the general process includes the following. Identify temporary accounts. The first step is to identify the temporary accounts that need to be closed. These accounts typically include revenue accounts, expense accounts, and dividend accounts. Close revenue accounts. Start by closing the revenue accounts. Transfer the balances of all revenue accounts to the income summary account. This step effectively moves the revenue from the income statement to the retained earnings account. Close expense accounts. Next, close the expense accounts. Transfer the balances of all expense accounts to the income summary account. This step reduces the expense amount from the income statement and adjusts the retained earnings accordingly. Calculate net income or loss. Calculate the net income or loss by subtracting the total expenses from the total revenues. This figure will be used in the next step. Close income summary account. Transfer the balance of the income summary account to the retained earnings account. If there is a net income, the income summary account will have a credit balance, which increases the retained earnings. If there is a net loss, the income summary account will have a debit balance, which decreases the retained earnings. Close dividend accounts. if the business distributes dividends, close the dividend accounts by transferring their balances to the retained earnings account. Dividends reduce the retained earnings, as they represent the distribution of profits to the shareholders. Verify balances. After completing the closing entries, verify that all temporary accounts have a zero balance. The retained earnings account should reflect the net income or loss for the period, and the permanent accounts should carry forward their balances to the next accounting period. Example of closing entries. To illustrate the closing process, let's consider a fictional company called ABC Corporation. At the end of the fiscal year, ABC Corporation has the following account balances. Revenue, $100,000. Expenses, $60,000. Dividends, $10,000. Here's how the closing entries would be recorded for ABC Corporation. Close revenue accounts. Debit revenue, $100,000. Credit income summary, $100,000. Close expense accounts. Debit income summary, $60,000. Credit expenses, $60,000. Calculate net income or loss. Net income equals total revenues. Total expenses. Net income equals $100,000 minus $60,000. Net income equals $40,000. Close income summary account. Debit income summary, $40,000. Credit retained earnings, $40,000. Close dividend accounts. Debit retained earnings, $10,000. Credit dividends, $10,000. After completing these closing entries, the temporary accounts revenue, expense, and dividend accounts will have zero balances, and the retained earnings account will reflect the net income of $40,000. The balances of the permanent accounts, such as assets, liabilities, and equity accounts, will carry forward to the next accounting period. Closing entries are crucial for maintaining accurate financial records and preparing the books for the next accounting period. By resetting temporary accounts and transferring their balances to the retained earnings account, closing entries ensure that the financial statements reflect the true financial position of the business. 5. Inventory and cost of goods sold. 5.1 Inventory valuation methods. Inventory valuation is a crucial aspect of accounting for businesses that deal with the buying and selling of goods. It involves determining the value of the inventory on hand at the end of an accounting period. The valuation of inventory is important for several reasons, including accurate financial reporting, determining the cost of goods sold, and assessing the profitability of a business. In this section, we will explore different inventory valuation methods commonly used in accounting. Specific identification method. The specific identification method is the most accurate inventory valuation method but is also the most time-consuming and costly. Under this method, each item in the inventory is individually identified and assigned a specific cost. When a sale occurs, the cost of the specific item sold is matched with the revenue generated from the sale. This method is commonly used for businesses that deal with unique or high-value items, such as art galleries or antique shops. First in, first out FIFO method. The first in, first out FIFO method assumes that the first items purchased are the first ones sold. Under this method, the cost of the oldest inventory is assigned to the cost of goods sold, while the cost of the most recent purchases is assigned to the ending inventory. This method follows the logical flow of inventory, as it assumes that the oldest items are sold first. FIFO is commonly used in industries where the products have a limited shelf life, such as the food industry. Let's consider an example to understand how the FIFO method works. Suppose a business purchases 100 units of a product at $10 each on January 1st and another 100 units at $12 each on February 1st. If the business sells 150 units in March, the cost of goods sold would be calculated as follows. 100 units at $10 each, from the January 1st purchase, 50 units at $12 each, from the February 1st purchase, the remaining 50 units would be considered as the ending inventory and would be valued at $12 each. Last in, first out LIFO method. The last in, first out LIFO method assumes that the most recent items purchased are the first ones sold. Under this method, the cost of the most recent purchases is assigned to the cost of goods sold, while the cost of the oldest inventory is assigned to the ending inventory. This method is based on the assumption that the most recent costs are more reflective of the current market prices. LIFO is commonly used in industries where the cost of inventory tends to increase over time, such as the oil and gas industry. Continuing with the previous example, if the business uses the LIFO method instead, the cost of goods sold would be calculated as follows. 100 units at $12 each, from the February 1st purchase, 50 units at $10 each, from the January 1st purchase, the remaining 50 units would be considered as the ending inventory and would be valued at $10 each. Weighted average cost method. The weighted average cost method calculates the average cost of all units in the inventory and assigns this average cost to both the cost of goods sold and the ending inventory. This method is based on the assumption that the cost of inventory is spread evenly across all units. To calculate the weighted average cost, the total cost of all units in the inventory is divided by the total number of units. Let's consider an example to understand how the weighted average cost method works. Suppose a business purchases 100 units of a product at $10 each and another 100 units at $12 each. The total cost of the inventory would be $2,200, $1,000 for the first purchase plus $1,200 for the second purchase. The total number of units in the inventory is 200. Therefore, the weighted average cost would be $11 per unit. If the business sells 150 units, the cost of goods sold and the ending inventory would both be valued at $11 per unit. Each inventory valuation method has its advantages and disadvantages, and the choice of method depends on various factors, including the nature of the business, industry practices, and applicable accounting standards. It is important for businesses to carefully consider the implications of each method and select the one that best aligns with their specific needs and circumstances. In the next section, we will explore the first in, first out FIFO method in more detail, including its advantages, disadvantages, and practical applications in different industries. 5.2 First in, first out FIFO. The first in, first out FIFO method is one of the most commonly used inventory valuation methods in accounting. It assumes that the first items purchased or produced are the first ones to be sold or used. In other words, under the FIFO method, the cost of the oldest inventory is matched with the revenue from the first units sold. How FIFO works. To understand how the FIFO method works, let's consider an example. Imagine a retail store that sells electronic gadgets. The store purchases 100 smartphones at $200 each on January 1st and another 200 smartphones at $220 each on February 1st. During the month of February, the store sells 150 smartphones. Under the FIFO method, the cost of goods sold COGS is calculated by assuming that the first 150 smartphones sold were from the January 1st purchase, and the remaining 50 smartphones in inventory are from the February 1st purchase. Therefore, the COGS would be calculated as follows. COGS equals 150 smartphones x $200 plus 50 smartphones x $220 equals $30,000 plus $11,000 equals $41,000. By using the FIFO method, the COGS reflects the cost of the oldest inventory first, which is consistent with the assumption that the first items purchased are the first ones to be sold. Advantages of FIFO. The FIFO method offers several advantages for businesses. Realistic cost allocation. FIFO provides a more realistic representation of the cost of goods sold because it matches the cost of the oldest inventory with the revenue from the first units sold. This method is particularly useful when the cost of inventory fluctuates over time. Tax benefits. FIFO can provide tax advantages in periods of rising prices. Since the cost of goods sold is calculated using the oldest inventory, which typically has a lower cost, the business reports higher profits and pays higher taxes. This can be beneficial for tax planning purposes. Better inventory management. FIFO helps businesses manage their inventory more effectively. By selling the oldest inventory first, businesses can avoid holding on to outdated or obsolete products, reducing the risk of inventory obsolescence. Accurate financial statements. FIFO provides accurate financial statements by reflecting the current market value of inventory. Since the cost of goods sold is based on the oldest inventory, the value of the remaining inventory on the balance sheet is more closely aligned with current market prices. Limitations of FIFO. While FIFO has its advantages, it also has some limitations that businesses should be aware of. Distorted profit margins. In periods of rising prices, the use of FIFO can result in distorted profit margins. Since the cost of goods sold is calculated using older, lower-cost inventory, the business may appear more profitable than it actually is. Tax disadvantages. While FIFO can provide tax benefits in certain situations, it can also lead to higher taxes in periods of falling prices. If the cost of inventory decreases over time, the business may report lower profits and pay lower taxes. Inventory valuation challenges. FIFO can present challenges in accurately valuing inventory, especially when the cost of inventory fluctuates significantly. Businesses need to carefully track the cost of each item in inventory to ensure accurate financial reporting. Potential for inventory hoarding. In some cases, businesses may be tempted to hoard inventory under the FIFO method. Since the cost of goods sold is based on the oldest inventory, businesses may delay selling newer inventory to maintain lower COGS and higher profits. FIFO and financial statements. The use of the FIFO method has a direct impact on the financial statements of a business. The balance sheet reflects the value of inventory at the cost of the most recent purchases, while the income statement shows the cost of goods sold based on the oldest inventory. Additionally, the FIFO method affects the calculation of key financial ratios. For example, the gross profit margin, which measures the profitability of a business, will be higher under FIFO compared to other inventory valuation methods when prices are rising. It's important for businesses to carefully consider the impact of the FIFO method on their financial statements and ratios, as it can significantly influence the perception of the company's financial performance and position. In conclusion, the first in, first out FIFO method is a widely used inventory valuation method in accounting. It provides a realistic allocation of costs, tax advantages in certain situations, and better inventory management. However, it can also distort profit margins, present challenges in inventory valuation, and potentially lead to inventory hoarding. Businesses should carefully evaluate the advantages and limitations of FIFO and consider its impact on financial statements and ratios. 5.3 Last in, first out LIFO. The last in, first out LIFO method is one of the inventory valuation methods used in accounting. It assumes that the most recently acquired inventory items are the first ones to be sold or used. In other words, under the LIFO method, the cost of goods sold COGS is calculated based on the cost of the most recent purchases, while the ending inventory is valued using the cost of the oldest purchases. How LIFO works. To understand how the LIFO method works, let's consider an example. Suppose a company purchases 100 units of a product at different prices throughout the year. The purchases are as follows. January, 50 units at $10 per unit. April, 30 units at $12 per unit. September, 20 units at $15 per unit. Now, if the company sells 80 units of the product, the LIFO method assumes that the 20 units sold were the ones purchased in September, followed by the 30 units purchased in April, and finally the remaining 30 units purchased in January. Therefore, the cost of goods sold would be calculated as follows. 20 units $15 per unit. September purchase equals $300. 30 units $12 per unit. April purchase equals $360. 30 units $10 per unit. January purchase equals $300. Total cost of goods sold equals $300 plus $360 plus $300 equals $960. The remaining 20 units from the January purchase would be considered as the ending inventory and valued at their original cost of $10 per unit, resulting in an ending inventory value of $200. Advantages of LIFO. The LIFO method offers several advantages to businesses, which is why it is commonly used, especially in industries where inventory costs tend to rise over time. Some of the advantages of using LIFO include tax benefits. LIFO can provide tax advantages in periods of inflation. Since the most recent and usually higher-priced inventory items are considered as sold, the cost of goods sold is higher, resulting in lower taxable income and, consequently, lower tax liabilities. Matching current costs. LIFO matches the current costs of inventory with the current revenue generated from sales. This can provide a more accurate representation of the profitability of a business, especially when prices are increasing. Realistic inventory valuation. LIFO reflects the current market value of inventory more accurately during periods of inflation. By valuing the ending inventory at older, lower costs, it avoids overstating the value of inventory on the balance sheet. Cash flow benefits. When prices are rising, using LIFO can result in lower taxable income, which means businesses have more cash available for other purposes, such as investing in growth opportunities or paying down debt. Disadvantages of LIFO. While LIFO has its advantages, it also has some disadvantages that businesses need to consider before adopting this inventory valuation method. These disadvantages include inventory distortion. LIFO can distort the value of inventory on the balance sheet, especially during periods of inflation. The ending inventory value may not reflect the current replacement cost of inventory, which can affect the accuracy of financial statements. Reduced profitability. Since the cost of goods sold is calculated based on the most recent purchases, LIFO can result in higher COGS and lower reported profits. This can impact the perception of a company's financial performance by investors and stakeholders. Inventory liquidation risk. During periods of rising prices, using LIFO may lead to a situation where the older, lower-cost inventory is depleted, and the remaining inventory consists of higher-cost items. This can result in higher COGS and lower profits in the future. Complex record keeping. Implementing LIFO requires meticulous record keeping to accurately track the cost of inventory purchases and sales. This can be more time-consuming and complex compared to other inventory valuation methods. LIFO conformity rule. It is important to note that if a company chooses to use the LIFO method for tax purposes, they must also use LIFO for financial reporting purposes. This is known as the LIFO conformity rule, which ensures consistency in inventory valuation between tax and financial statements. The LIFO conformity rule is enforced by tax authorities to prevent companies from taking advantage of the tax benefits of LIFO without reflecting the same inventory valuation in their financial statements. Failure to comply with the LIFO conformity rule can result in penalties and adjustments to taxable income. Conclusion. The last in, first out LIFO method is an inventory valuation method that assumes the most recently acquired inventory items are the first ones to be sold or used. It offers advantages such as tax benefits, matching current costs with revenue, realistic inventory valuation, and cash flow benefits. However, it also has disadvantages, including inventory distortion, reduced profitability, inventory liquidation risk, and complex record keeping. Businesses considering LIFO should carefully evaluate these factors and ensure compliance with the LIFO conformity rule if they choose to use it for tax purposes. 5.4 Weighted average cost. In the previous sections, we discussed two popular methods of inventory valuation: first in, first out FIFO, and last in, first out LIFO. These methods assume that the cost of inventory is either based on the oldest or the most recent purchases. However, there is another commonly used method called weighted average cost, which takes into account the average cost of all units in inventory. Understanding weighted average cost. The weighted average cost method calculates the average cost of all units in inventory by dividing the total cost of goods available for sale by the total number of units available for sale. This average cost is then used to determine the value of both the ending inventory and the cost of goods sold. To illustrate this method, let's consider an example. Suppose a company purchases 100 units of a product at $10 each and later purchases an additional 200 units at $12 each. According to the weighted average cost method, the average cost per unit would be calculated as follows. Average cost equals 100 units asterisk $10 plus 200 units asterisk $12, 100 units plus 200 units. Equals $1,000 plus $2,400 per 300 units equals $3,400 per 300 units equals $11.33 per unit. Once the average cost per unit is determined, it is used to calculate the value of the ending inventory and the cost of goods sold. For example, if the company has 150 units remaining in inventory at the end of the accounting period, the value of the ending inventory would be ending inventory value equals 150 units asterisk $11.33 per unit equals $1,699.50. Similarly, the cost of goods sold would be calculated by multiplying the average cost per unit by the number of units sold during the period. Advantages of weighted average cost. The weighted average cost method offers several advantages for businesses. Simplicity. Compared to other inventory valuation methods, such as FIFO and LIFO, the weighted average cost method is relatively simple to calculate and understand. It does not require tracking the specific cost of each individual unit. Smoothing effect. The weighted average cost method smooths out the fluctuations in inventory costs by taking into account the average cost of all units. This can be particularly useful when there are significant price fluctuations in the market. Reflects current market conditions. Since the weighted average cost method considers the average cost of all units, it reflects the current market conditions more accurately than methods like FIFO or LIFO, which rely on specific purchase prices. Suitable for homogeneous products. The weighted average cost method is particularly suitable for businesses that deal with homogeneous products, where there is no significant difference between individual units. This method works well for products that are interchangeable and have similar costs. Limitations of weighted average cost. While the weighted average cost method has its advantages, it also has some limitations that businesses should be aware of. Distorted profit margins. The use of weighted average cost can distort profit margins, especially during periods of significant price fluctuations. This is because the average cost per unit may not accurately reflect the actual cost of the most recent purchases. Inaccurate valuation. The weighted average cost method may not provide an accurate valuation of inventory when there are significant differences in the costs of individual units. For example, if a company has old inventory with a much lower cost than the current market price, the average cost may not reflect the true value of the inventory. Complexity in tracking costs. While the calculation of the weighted average cost itself is relatively simple, tracking the cost of each individual unit can be complex, especially for businesses with large inventories. This can result in additional administrative burden and potential errors. Incompatibility with specific identification. The weighted average cost method is not compatible with the specific identification method, where each unit of inventory is individually tracked and valued. This can be a limitation for businesses that require precise tracking of inventory costs. Choosing the right inventory valuation method. The choice of inventory valuation method, whether it is FIFO, LIFO, or weighted average cost, depends on various factors such as the nature of the business, industry practices, and tax regulations. Each method has its own advantages and limitations, and businesses should carefully consider their specific needs and circumstances before selecting a method. Weighted average cost is often favored by businesses that deal with homogeneous products and want to smooth out the impact of price fluctuations. It provides a simple and practical approach to inventory valuation, especially when the cost of individual units is not significantly different. In conclusion, the weighted average cost method is a widely used inventory valuation method that calculates the average cost of all units in inventory. It offers simplicity, a smoothing effect, and reflects current market conditions. However, it may distort profit margins, provide inaccurate valuation in certain situations, and require complex cost tracking. Businesses should carefully evaluate their needs and circumstances to determine the most suitable inventory valuation method for their operations. 6. Accounts receivable and bad debts. 6.1 Recognizing accounts receivable. Accounts receivable is a crucial aspect of a company's financial health. It represents the amount of money owed to a business by its customers for goods or services provided on credit. Recognizing accounts receivable is the process of recording and reporting these outstanding customer debts in the company's financial statements. When a company sells goods or services on credit, it creates an account receivable. This means that the customer has received the goods or services but has not yet paid for them. The company expects to receive payment from the customer in the future, and therefore, records the amount owed as an asset on its balance sheet. To recognize accounts receivable, the company must follow certain accounting principles and guidelines. The revenue recognition principle states that revenue should be recognized when it is earned, regardless of when the payment is received. This means that accounts receivable should be recorded at the time of sale or when the service is provided, even if the customer has not yet paid. The process of recognizing accounts receivable begins with the creation of a sales invoice or a sales journal entry. The invoice includes details such as the customer's name, the date of the sale, the description of the goods or services provided, and the amount owed. This invoice serves as a formal request for payment and provides documentation of the transaction. Once the invoice is created, it is recorded in the company's accounting system. The accounts receivable account is debited, increasing the amount owed by the customer, and the revenue account is credited, recognizing the revenue earned from the sale. This double entry accounting ensures that the company's financial statements remain balanced. It is important for companies to accurately recognize accounts receivable to provide an accurate picture of their financial position. This information is crucial for making informed business decisions, managing cash flow, and assessing the company's creditworthiness. There are several methods that companies can use to recognize accounts receivable. The most common method is the accrual basis of accounting, where revenue is recognized when it is earned, regardless of when the payment is received. This method provides a more accurate representation of a company's financial performance over a given period. Another method is the cash basis of accounting, where revenue is recognized only when the payment is received. This method is simpler and easier to implement, but it may not provide an accurate picture of a company's financial performance, especially if there are significant time lags between the sale and the receipt of payment. Companies must also consider the collectibility of accounts receivable when recognizing them. If there is doubt about the customer's ability or willingness to pay, the company may need to make adjustments to the accounts receivable balance. This is done through an allowance for doubtful accounts, which is a contra-asset account that reduces the accounts receivable balance to reflect the estimated amount that will not be collected. To determine the allowance for doubtful accounts, companies use various methods such as the percentage of sales method or the aging of accounts receivable method. These methods estimate the percentage of accounts receivable that is expected to be uncollectible based on historical data and industry norms. Once the allowance for doubtful accounts is established, it is recorded as an expense on the income statement, reducing the company's net income. This expense serves as a provision for potential bad debts and helps to ensure that the accounts receivable balance is stated at its net realizable value. In conclusion, recognizing accounts receivable is a critical step in the accounting process. It involves recording and reporting the amount owed to a company by its customers for goods or services provided on credit. By following accounting principles and guidelines, companies can accurately reflect their financial position and make informed business decisions. The allowance for doubtful accounts is an important consideration in recognizing accounts receivable, as it helps to account for potential bad debts and ensures that the accounts receivable balance is stated at its net realizable value. 6.2 Allowance for doubtful accounts. The allowance for doubtful accounts is an important concept in accounting that helps businesses account for potential losses due to customers who may not pay their outstanding debts. Also known as the provision for bad debts or the allowance for bad debts, this account is created to estimate and record the amount of accounts receivable that is expected to be uncollectible. Purpose of the allowance for doubtful accounts. The purpose of the allowance for doubtful accounts is to ensure that a company's financial statements accurately reflect the true value of its accounts receivable. Since not all customers may fulfill their payment obligations, it is necessary to account for potential losses. By creating an allowance, businesses can estimate the amount of accounts receivable that is likely to be uncollectible and adjust their financial statements accordingly. Estimating the allowance for doubtful accounts. Estimating the allowance involves a certain level of judgment and analysis. There are several methods that businesses can use to estimate the amount of uncollectible accounts. The most common methods include the percentage of sales method and the aging of accounts receivable method. Percentage of sales method. This method estimates the allowance based on a percentage of the total sales made during a specific period. The percentage is determined based on historical data and industry averages. For example, if a company determines that historically 2% of its sales result in bad debts, it would multiply the total sales for the period by 2% to calculate the allowance. Aging of accounts receivable method. This method categorizes accounts receivable based on their age and assigns different percentages to each category. The percentages are based on historical data and the likelihood of collection. For example, accounts receivable that are less than 30 days old may have a lower percentage of being uncollectible compared to those that are over 90 days old. The total of the percentages assigned to each category is then multiplied by the respective outstanding balances to calculate the allowance. It is important for businesses to regularly review and update their estimates for the allowance for doubtful accounts to ensure accuracy. Changes in economic conditions, customer payment patterns, and industry trends can all impact the collectibility of accounts receivable. Recording the allowance for doubtful accounts. Once the estimate for the allowance for doubtful accounts has been determined, it needs to be recorded in the company's financial statements. The allowance is recorded as a contra-asset account, meaning it reduces the value of the accounts receivable. The journal entry to record the allowance typically involves debiting the allowance for doubtful accounts and crediting the accounts receivable. For example, if a company estimates that $10,000 of its accounts receivable is likely to be uncollectible, it would record a journal entry as follows. Allowance for doubtful accounts $10,000, accounts receivable $10,000. This entry reduces the accounts receivable by $10,000, reflecting the estimated amount that is not expected to be collected. Impact on financial statements. The allowance for doubtful accounts has a direct impact on a company's financial statements. By creating the allowance, the company is able to report a more accurate value for its accounts receivable. This, in turn, affects the balance sheet and income statement. On the balance sheet, the allowance for doubtful accounts is subtracted from the accounts receivable to show the net realizable value. The net realizable value represents the amount of accounts receivable that the company expects to collect. On the income statement, the allowance for doubtful accounts is typically included as an expense under the heading of bad debt expense or uncollectible accounts expense. This expense is recognized to match the estimated uncollectible accounts with the revenue they were generated from. Recovery of bad debts. In some cases, a customer who was previously considered uncollectible may make a payment towards their outstanding debt. When this happens, the company needs to record the recovery of the bad debt. To record the recovery, the company would reverse the original entry made to the allowance for doubtful accounts and accounts receivable. The journal entry would involve debiting the accounts receivable and crediting the allowance for doubtful accounts. For example, if a customer previously had $1,000 written off as a bad debt but later makes a payment of $500, the company would record the following journal entry. Accounts receivable $500, allowance for doubtful accounts $500. This entry reduces the allowance for doubtful accounts by $500 and increases the accounts receivable by the same amount, reflecting the recovery of the previously written off bad debt. Conclusion. The allowance for doubtful accounts is a crucial aspect of accounting that helps businesses account for potential losses due to uncollectible accounts receivable. By estimating and recording the allowance, companies can ensure that their financial statements accurately reflect the true value of their accounts receivable. Regular review and updates to the allowance are necessary to account for changes in economic conditions and customer payment patterns. 6.3 Writing off bad debts. In the world of accounting, bad debts are an unfortunate reality that businesses have to deal with. A bad debt refers to an amount owed by a customer or client that is unlikely to be collected. When a business determines that a debt is uncollectible, it needs to write off the bad debt from its accounts. Writing off bad debts is an essential step in maintaining accurate financial records and reflecting the true financial position of a company. The need to write off bad debts. When a customer fails to pay their outstanding balance, it can have a significant impact on a company's financial health. Unpaid debts tie up valuable resources and can hinder cash flow, making it difficult for a business to meet its own financial obligations. Writing off bad debts allows a company to remove these uncollectible amounts from its accounts receivable and accurately reflect the true value of its assets. Recognizing a bad debt. Before a bad debt can be written off, it must be recognized as such. The recognition of a bad debt typically occurs when a business determines that there is no reasonable expectation of collecting the outstanding amount. This determination is usually made after exhausting all reasonable collection efforts, such as sending reminders, making phone calls, or even pursuing legal action. To recognize a bad debt, the business needs to adjust its accounts receivable and allowance for doubtful accounts. The allowance for doubtful accounts is a contra-asset account that represents the estimated amount of uncollectible accounts receivable. By adjusting this account, the business can reflect the anticipated losses from bad debts. Writing off bad debts. Once a bad debt has been recognized, it is time to write it off. Writing off a bad debt involves removing the outstanding amount from the accounts receivable and reducing the allowance for doubtful accounts. This process ensures that the financial statements accurately reflect the loss incurred by the business. To write off a bad debt, the following journal entry is typically recorded. Debit allowance for doubtful accounts, credit accounts receivable. By debiting the allowance for doubtful accounts, the business reduces the estimated amount of uncollectible accounts receivable. Simultaneously, by crediting the accounts receivable, the specific customer's outstanding balance is removed from the books. It is important to note that writing off a bad debt does not mean that the business has given up on collecting the outstanding amount. It simply means that the company has recognized the unlikelihood of collecting the debt and has adjusted its financial records accordingly. Impact on financial statements. Writing off bad debts has a direct impact on a company's financial statements. The income statement is affected because the bad debt expense is recognized as an operating expense, reducing the company's net income. This reduction in net income reflects the reality that the business has incurred a loss due to uncollectible debts. Additionally, the balance sheet is impacted as well. The accounts receivable balance is reduced, reflecting the removal of the bad debt. The allowance for doubtful accounts is also adjusted, reducing the estimated amount of uncollectible accounts receivable. These adjustments ensure that the financial statements accurately represent the company's financial position. Recovery of bad debts. While writing off bad debts is a necessary step, it does not mean that the business cannot recover the outstanding amount in the future. If a previously written off debt is eventually collected, the recovery is recorded as a separate transaction. To record the recovery of a bad debt, the following journal entry is typically recorded. Debit accounts receivable, credit allowance for doubtful accounts. By debiting the accounts receivable, the business increases the specific customer's outstanding balance. Simultaneously, by crediting the allowance for doubtful accounts, the estimated amount of uncollectible accounts receivable is reduced. The recovery of a bad debt has a positive impact on the financial statements. The income statement reflects the recovery as a reduction in bad debt expense, increasing the company's net income. The balance sheet is also affected, with an increase in the accounts receivable balance and a decrease in the allowance for doubtful accounts. Conclusion. Writing off bad debts is an essential part of the accounting process. It allows businesses to accurately reflect the financial impact of uncollectible debts and maintain the integrity of their financial statements. By recognizing and writing off bad debts, companies can better manage their accounts receivable and make informed decisions about credit policies and collection efforts. While writing off bad debts may seem like a negative aspect of accounting, it is a necessary step in ensuring the financial health and stability of a business. 6.4 Recovering bad debts. Recovering bad debts is an essential part of managing accounts receivable for any business. When customers fail to pay their outstanding invoices, it can have a significant impact on the company's cash flow and overall financial health. In this section, we will explore the process of recovering bad debts and the strategies that businesses can employ to minimize losses and improve collections. The importance of recovering bad debts. When a customer fails to pay their outstanding debt, it becomes a bad debt for the business. Bad debts can arise due to various reasons, such as financial difficulties, bankruptcy, or disputes over the quality of goods or services provided. Regardless of the reason, bad debts can have a detrimental effect on a company's financial stability. Recovering bad debts is crucial for several reasons. Improving cash flow. Recovering bad debts helps to improve the company's cash flow by converting outstanding receivables into cash. This, in turn, allows the business to meet its financial obligations, pay suppliers, and invest in growth opportunities. Minimizing losses. By actively pursuing the recovery of bad debts, businesses can minimize their losses. Writing off bad debts without making any effort to recover them can result in a significant financial hit for the company. Maintaining customer relationships. Effective debt recovery strategies can help maintain positive relationships with customers. By addressing outstanding debts promptly and professionally, businesses can preserve customer loyalty and trust. Strategies for recovering bad debts. Recovering bad debts requires a systematic approach and the implementation of effective strategies. Here are some strategies that businesses can employ to improve their chances of recovering outstanding debts. Establish clear credit policies. To minimize the risk of bad debts, businesses should establish clear credit policies. These policies should outline the terms and conditions of credit sales, including credit limits, payment terms, and consequences for late or non-payment. Regularly monitor accounts receivable. Regularly monitoring accounts receivable allows businesses to identify delinquent accounts promptly. By keeping a close eye on aging reports and payment patterns, companies can take immediate action to recover outstanding debts. Send reminder notices. Sending reminder notices to customers with overdue payments is an effective way to prompt them to settle their debts. These notices should be polite yet firm, clearly stating the outstanding amount, due date, and consequences of non-payment. Establish payment plans. In some cases, customers may be experiencing temporary financial difficulties. Offering them the option to set up a payment plan can help them fulfill their obligations while still maintaining a positive relationship with the business. Utilize collection agencies. If internal efforts to recover bad debts prove unsuccessful, businesses can consider engaging collection agencies. Collection agencies specialize in debt recovery and have the expertise and resources to pursue delinquent accounts more aggressively. Negotiate settlements. In situations where the customer is unable to pay the full outstanding amount, negotiating a settlement can be a viable option. This involves reaching an agreement with the customer to accept a reduced payment in full satisfaction of the debt. Legal action. As a last resort, businesses may need to pursue legal action to recover bad debts. This typically involves filing a lawsuit against the debtor and seeking a court judgment. However, legal action should only be taken after careful consideration of the costs involved and the likelihood of success. Best practices for recovering bad debts. In addition to the strategies mentioned above, there are some best practices that businesses should follow when it comes to recovering bad debts. Maintain accurate records. Accurate and up-to-date records of all customer transactions, including invoices, payment receipts, and communication, are essential for effective debt recovery. These records serve as evidence in case legal action becomes necessary. Communicate clearly and professionally. When communicating with customers regarding their outstanding debts, it is crucial to maintain a professional and respectful tone. Clear and concise communication helps to avoid misunderstandings and maintain positive customer relationships. Document all communication. It is important to document all communication with customers regarding their outstanding debts. This includes phone calls, emails, and letters. Keeping a record of these interactions helps to track progress and provides evidence if legal action becomes necessary. Be persistent but respectful. Persistence is key when it comes to recovering bad debts. However, it is equally important to be respectful and understanding of the customer's situation. Adopting a balanced approach can help maintain a positive relationship while still pursuing debt recovery. Regularly review and update collection policies. Collection policies should be regularly reviewed and updated to ensure they remain effective. As the business evolves and market conditions change, it is essential to adapt collection strategies accordingly. By implementing these strategies and best practices, businesses can improve their chances of recovering bad debts and minimize the impact on their financial health. Effective debt recovery not only improves cash flow but also helps maintain positive customer relationships and ensures the long-term sustainability of the business. 7. Accounts payable and accrued expenses. 7.1 Recognizing accounts payable. Accounts payable is a crucial aspect of accounting that involves the recognition and management of a company's outstanding debts to its suppliers and vendors. In this section, we will explore the process of recognizing accounts payable, its importance in financial reporting, and the impact it has on a company's financial statements. Understanding accounts payable. Accounts payable refers to the amount of money that a company owes to its suppliers or vendors for goods or services received but not yet paid for. These outstanding debts are considered liabilities on the company's balance sheet and are typically classified as short-term liabilities since they are expected to be paid within a year. When a company purchases goods or services on credit, it creates an accounts payable entry to record the amount owed. This entry is made in the company's accounting system, usually in the accounts payable subsidiary ledger. The accounts payable subsidiary ledger provides detailed information about each individual supplier or vendor and the outstanding balances owed to them. Importance of recognizing accounts payable. Recognizing accounts payable accurately is essential for several reasons. Firstly, it ensures that a company's financial statements reflect its true financial position. By recording accounts payable, the company acknowledges its obligations and provides a comprehensive view of its liabilities. Secondly, recognizing accounts payable allows for proper cash flow management. By keeping track of outstanding debts, a company can plan its cash outflows and ensure that it has sufficient funds to meet its payment obligations. This is particularly important for managing working capital and maintaining healthy relationships with suppliers. Furthermore, recognizing accounts payable enables accurate financial reporting. Companies are required to disclose their accounts payable balances in their financial statements, such as the balance sheet and the statement of cash flows. These statements provide valuable information to investors, creditors, and other stakeholders, allowing them to assess the company's financial health and make informed decisions. Recording accounts payable. The process of recording accounts payable involves several steps. Let's take a closer look at each of these steps. Purchase of goods or services. The accounts payable process begins with the purchase of goods or services on credit. When a company receives an invoice from a supplier, it creates a purchase order or a purchase requisition to initiate the purchase. Invoice verification. Once the goods or services are received, the company verifies the accuracy of the invoice. This involves matching the invoice details with the purchase order and the goods received. Any discrepancies or issues are resolved with the supplier before proceeding. Recording the invoice. After the invoice is verified, it is recorded in the accounting system. The accounts payable department enters the invoice details, such as the supplier's name, invoice number, date, and the amount owed, into the accounts payable subsidiary ledger. Approval and payment. The recorded invoice goes through an approval process, where it is reviewed and authorized for payment. The payment terms agreed upon with the supplier, such as the due date and any applicable discounts, are taken into consideration. Payment processing. Once approved, the payment is processed by the accounts payable department. This may involve issuing a check, initiating an electronic funds transfer, or any other agreed upon payment method. The payment is then recorded in the accounting system, reducing the accounts payable balance. Impact on financial statements. Recognizing accounts payable has a significant impact on a company's financial statements, particularly the balance sheet and the statement of cash flows. On the balance sheet, accounts payable is reported as a current liability. It is listed under the liabilities section and represents the amount owed to suppliers or vendors as of the reporting date. The accounts payable balance is crucial for calculating working capital and assessing a company's short-term liquidity. In the statement of cash flows, changes in accounts payable are reflected in the operating activities section. An increase in accounts payable indicates that the company has received goods or services on credit, resulting in a decrease in cash outflows. Conversely, a decrease in accounts payable suggests that the company has made payments to reduce its outstanding debts, resulting in a decrease in cash inflows. Conclusion. Recognizing accounts payable is a fundamental aspect of accounting that ensures accurate financial reporting and effective cash flow management. By properly recording and managing accounts payable, companies can maintain healthy relationships with suppliers, meet their payment obligations, and provide transparent financial information to stakeholders. Understanding the process of recognizing accounts payable is essential for anyone involved in financial management or accounting. 7.2 Accrued expenses. Accrued expenses are a crucial aspect of accounting that helps businesses accurately reflect their financial position. In this section, we will explore what accrued expenses are, how they are recorded, and their significance in financial reporting. Definition of accrued expenses. Accrued expenses, also known as accrued liabilities or accrued costs, are expenses that a company has incurred but has not yet paid for. These expenses are recognized in the accounting records even though the payment has not been made. Accrued expenses are typically incurred when a company receives goods or services but has not received an invoice or made a payment for them. Accrued expenses can include various costs, such as salaries and wages, interest expenses, utilities, rent, and taxes. These expenses are recognized in the period in which they are incurred, regardless of when the payment is made. Recording accrued expenses. To record accrued expenses, companies use the accrual basis of accounting. Under the accrual basis, revenues and expenses are recognized when they are earned or incurred, regardless of when the cash is received or paid. The process of recording accrued expenses involves two steps: recognition and adjustment. Recognition. The recognition of accrued expenses occurs when the company incurs the expense but has not yet received an invoice or made a payment. At this stage, an adjusting entry is made to recognize the expense and record it in the financial statements. Adjustment. The adjustment of accrued expenses is made at the end of the accounting period to ensure that the financial statements accurately reflect the company's financial position. This adjustment involves updating the accounts and adjusting the corresponding expense and liability accounts. For example, let's say a company has incurred $5,000 in salaries and wages for the month of December, but the payment will be made in January. To record this accrued expense, the company would debit the salaries and wages expense account for $5,000 and credit the salaries and wages payable account for the same amount. This entry recognizes the expense in December and creates a liability for the unpaid amount. Significance of accrued expenses. Accrued expenses play a vital role in financial reporting as they ensure that expenses are recognized in the correct accounting period. Here are some key reasons why accrued expenses are significant. Accurate financial statements. By recording accrued expenses, companies can provide a more accurate representation of their financial position. Accrued expenses help match expenses with the period in which they are incurred, providing a more realistic view of the company's profitability. Timely decision-making. Accrued expenses enable management to make informed decisions based on up-to-date financial information. By recognizing expenses as they are incurred, management can assess the company's financial health and make necessary adjustments or take corrective actions promptly. Compliance with accounting standards. Accrued expenses are an essential component of the accrual basis of accounting, which is widely accepted and required by accounting standards such as Generally Accepted Accounting Principles (GAAP). Adhering to these standards ensures consistency and comparability in financial reporting. Accurate tax reporting. Accrued expenses also impact tax reporting. By recognizing expenses in the correct accounting period, companies can accurately calculate their taxable income and comply with tax regulations. Transparency and stakeholder confidence. Accurate financial reporting, including the recognition of accrued expenses, enhances transparency and builds stakeholder confidence. Investors, creditors, and other stakeholders rely on financial statements to assess a company's performance and make informed decisions. Examples of accrued expenses. To further illustrate accrued expenses, let's consider a few examples. Interest expense. A company borrows funds from a bank and incurs interest expense on the outstanding loan balance. Even if the payment is due at the end of the month, the company recognizes the interest expense throughout the month as it accrues. Utilities. A company receives its monthly utility bill at the beginning of the following month. However, the company recognizes the expense in the month it consumes the utilities, even if the payment is made later. Rent. A company rents office space and pays rent on a quarterly basis. If the payment is due in the next quarter, the company recognizes the rent expense in the current quarter based on the rental agreement. Salaries and wages. As mentioned earlier, salaries and wages are often accrued at the end of the accounting period to ensure that employees' work is properly recognized and accounted for. These examples demonstrate how accrued expenses are incurred and recognized in various business scenarios, highlighting the importance of accurately recording these expenses. In conclusion, accrued expenses are an integral part of accounting that ensures expenses are recognized in the correct accounting period. By recording accrued expenses, companies can provide accurate financial statements, make timely decisions, comply with accounting standards, and enhance transparency. Understanding and properly recording accrued expenses is essential for businesses to maintain accurate financial records and effectively manage their financial operations. 7.3 Recording and paying bills. In any business, it is essential to keep track of the bills that need to be paid. Recording and paying bills accurately and on time is crucial for maintaining good relationships with vendors and suppliers, as well as for managing the financial health of the business. This section will discuss the process of recording and paying bills, including the necessary steps and best practices to ensure accuracy and efficiency. Recording bills. Recording bills involves documenting the details of the invoices received from vendors or suppliers. This step is crucial for maintaining an accurate record of the company's financial transactions and ensuring that all expenses are properly accounted for. Here are the steps involved in recording bills. Receive the invoice. When a vendor or supplier sends an invoice for goods or services provided, it should be promptly received and reviewed for accuracy. The invoice should include essential details such as the vendor's name, invoice number, date, description of the goods or services, quantity, unit price, and total amount due. Verify the invoice. Before recording the bill, it is important to verify the accuracy of the invoice. This includes checking for any discrepancies or errors in pricing, quantities, or terms. Any discrepancies should be resolved with the vendor before proceeding. Assign an account code. Each bill should be assigned an appropriate account code or expense category. This helps in organizing and categorizing expenses for financial reporting purposes. The account code should align with the company's chart of accounts and accounting system. Enter the bill in the accounting system. Once the invoice has been verified and assigned an account code, it should be entered into the company's accounting system. This can be done manually or electronically, depending on the accounting software used. The bill should be recorded with the vendor's name, invoice number, date, amount due, and the assigned account code. Review and approve. After entering the bill into the accounting system, it should be reviewed and approved by the appropriate person within the organization. This ensures that the bill is valid, accurate, and authorized for payment. Paying bills. Once bills have been recorded, it is important to pay them in a timely manner to maintain good relationships with vendors and avoid late payment penalties. Here are the steps involved in paying bills. Review payment terms. Before paying a bill, it is important to review the payment terms specified by the vendor. Payment terms may include the due date, any early payment discounts, and acceptable payment methods. Understanding the payment terms helps in planning and prioritizing bill payments. Schedule payments. Based on the payment terms and the company's cash flow situation, bills should be scheduled for payment. This involves determining the payment date and ensuring that sufficient funds are available to cover the payment. Many businesses use accounting software or online banking platforms to schedule and automate bill payments. Prepare payment documentation. Before making a payment, it is important to prepare the necessary documentation. This may include a check, electronic funds transfer, EFT authorization, or other payment instructions. The documentation should include the vendor's name, invoice number, payment amount, and any relevant reference numbers. Authorize and execute payment. Once the payment documentation is prepared, it should be authorized by the appropriate person within the organization. This ensures that the payment is valid and authorized. The payment can then be executed through the chosen payment method, such as issuing a check or initiating an electronic transfer. Record the payment. After the payment has been made, it should be recorded in the accounting system. This involves updating the bill record with the payment date, payment method, and any reference numbers. Recording the payment ensures that the bill is marked as paid and the accounts payable balance is accurately reflected. Best practices for recording and paying bills. To ensure accuracy and efficiency in recording and paying bills, it is important to follow best practices. Here are some tips to consider. Maintain a centralized bill management system. Having a centralized system for receiving, reviewing, and recording bills helps in streamlining the process and avoiding duplicate payments or missed invoices. This can be achieved through the use of accounting software or a dedicated bill management system. Implement segregation of duties. To prevent fraud or errors, it is important to have a separation of duties in the bill recording and payment process. This means that different individuals should be responsible for receiving, reviewing, approving, and executing payments. This helps in ensuring accountability and reducing the risk of unauthorized payments. Regularly reconcile accounts payable. It is important to regularly reconcile the accounts payable balance with vendor statements to ensure accuracy and identify any discrepancies. Reconciliation involves comparing the recorded bills with the vendor statements and resolving any differences or outstanding issues. Take advantage of vendor discounts. Some vendors offer early payment discounts as an incentive for prompt payment. It is important to take advantage of these discounts whenever possible, as they can help in reducing costs and improving cash flow. Monitor and manage cash flow. Maintaining a healthy cash flow is crucial for timely bill payments. It is important to regularly monitor and manage cash flow to ensure that sufficient funds are available to cover bill payments. This can be achieved through cash flow forecasting, managing receivables and payables, and implementing effective cash management strategies. By following these best practices, businesses can ensure that bills are accurately recorded and paid on time, leading to better financial management and stronger vendor relationships. 7.4 Vendor discounts and payment terms. In the world of business, managing cash flow is crucial for the success and sustainability of any organization. One way to optimize cash flow is by taking advantage of vendor discounts and negotiating favorable payment terms with suppliers. This section will explore the concept of vendor discounts, the benefits they offer, and how to effectively manage payment terms to maximize cash flow. Understanding vendor discounts. Vendor discounts, also known as trade discounts or cash discounts, are incentives offered by suppliers to encourage prompt payment from their customers. These discounts are typically expressed as a percentage reduction in the purchase price and are often denoted with terms such as 2/10, net 30. Let's break down what this means. The first number, 2, represents the discount percentage. In this example, the buyer would receive a 2% discount if the invoice is paid within the specified discount period. The second number, 10, indicates the number of days within which the buyer must pay to qualify for the discount. The term, net 30 inches, signifies the total number of days allowed for payment without any discount. In this case, the buyer has 30 days to pay the full invoice amount. By taking advantage of vendor discounts, businesses can reduce their costs of goods sold, COGS, and improve their bottom line. However, it's important to carefully evaluate the financial implications of these discounts and consider the impact on cash flow before making a decision. Benefits of vendor discounts. Cost savings. The primary benefit of vendor discounts is the potential cost savings they offer. By paying invoices early and taking advantage of the discount, businesses can reduce their expenses and increase their profit margins. Improved cash flow. Vendor discounts can significantly improve cash flow by accelerating the collection of accounts payable. By paying invoices promptly, businesses can maintain positive relationships with suppliers and negotiate better payment terms in the future. Strengthen supplier relationships. Timely payment of invoices can help build strong relationships with suppliers. This can lead to better communication, preferential treatment, and even potential discounts on future purchases. Competitive advantage. By effectively managing vendor discounts, businesses can gain a competitive edge over their competitors. Lower costs can be passed on to customers, allowing for more competitive pricing and potentially attracting more customers. Managing payment terms. To effectively manage payment terms and take advantage of vendor discounts, businesses should consider the following strategies. Negotiate favorable terms. When establishing relationships with suppliers, negotiate payment terms that align with your cash flow needs. Seek longer payment periods or more generous discount terms whenever possible. Evaluate the cost-benefit analysis. Before deciding to take a vendor discount, carefully evaluate the financial impact. Compare the discount percentage with alternative investment opportunities to ensure that accepting the discount is the most profitable option. Monitor cash flow. Regularly monitor your cash flow to ensure that you have sufficient funds to take advantage of vendor discounts. Implement effective cash flow management practices, such as maintaining a cash reserve or utilizing a line of credit, to ensure timely payment. Utilize technology. Consider implementing accounting software or enterprise resource planning (ERP) systems that can automate payment reminders and track vendor discounts. These tools can help streamline the payment process and ensure that discounts are not missed. Build strong supplier relationships. Cultivate strong relationships with suppliers by communicating regularly and demonstrating reliability in payment. This can lead to more favorable payment terms and potential discounts in the future. Prioritize invoices strategically. If cash flow is limited, prioritize invoices based on the available discounts and due dates. Paying invoices with the highest discounts first can maximize cost savings. Regularly review and renegotiate terms. As your business grows and evolves, regularly review your payment terms and renegotiate with suppliers. Changes in purchasing volume or market conditions may warrant adjustments to payment terms to better align with your business needs. By effectively managing vendor discounts and payment terms, businesses can optimize their cash flow, reduce costs, and strengthen supplier relationships. It requires careful evaluation, strategic planning, and regular monitoring of cash flow to ensure that the benefits of vendor discounts are maximized. 8. Budgeting and forecasting. 8.1 Importance of budgeting. Budgeting is a fundamental aspect of financial management for any organization, whether it is a small business, a nonprofit organization, or a large corporation. It involves the process of creating a detailed plan for the allocation of financial resources over a specific period. Budgeting plays a crucial role in the overall financial planning and control of an organization, providing a roadmap for achieving financial goals and objectives. In this section, we will explore the importance of budgeting and its various benefits. Planning and goal setting. One of the primary reasons why budgeting is essential is that it allows organizations to plan and set financial goals. By creating a budget, businesses can determine their expected income and expenses, enabling them to set realistic targets for revenue generation and cost control. Budgeting helps organizations identify their financial priorities and allocate resources accordingly. It provides a framework for decision-making, ensuring that financial resources are utilized effectively to achieve strategic objectives. Financial control and accountability. Budgeting also plays a vital role in financial control and accountability. It provides a benchmark against which actual financial performance can be measured. By comparing actual results with the budgeted figures, organizations can identify any deviations and take corrective actions promptly. Budgeting helps in monitoring expenses, controlling costs, and ensuring that financial resources are used efficiently. It promotes accountability within the organization, as managers are responsible for adhering to the budget and justifying any variances. Resource allocation and optimization. Effective resource allocation is crucial for the success of any organization. Budgeting helps in optimizing the allocation of financial resources by identifying areas where resources can be allocated most efficiently. It allows organizations to prioritize their spending and allocate resources to projects or activities that align with their strategic objectives. By analyzing the budget, organizations can identify areas of overspending or underutilization of resources and make necessary adjustments to optimize resource allocation. Cash flow management. Cash flow is the lifeblood of any organization. Budgeting helps in managing cash flow effectively by forecasting the timing and amount of cash inflows and outflows. By creating a cash flow budget, organizations can anticipate periods of cash surplus or deficit and take appropriate measures to ensure sufficient liquidity. Budgeting allows businesses to plan for capital expenditures, debt repayments, and other cash outflows, ensuring that they have the necessary funds available when needed. Decision-making and risk management. Budgeting provides valuable information for decision-making and risk management. It helps organizations evaluate the financial feasibility of potential projects or investments by considering their impact on the budget. By analyzing the budgeted financial statements, organizations can assess the potential risks and rewards associated with different courses of action. Budgeting enables businesses to make informed decisions, considering the financial implications and aligning them with their overall strategic objectives. Performance evaluation and accountability. Budgeting facilitates performance evaluation by providing a benchmark for measuring actual financial performance. By comparing actual results with the budgeted figures, organizations can assess their financial performance and identify areas of improvement. Budget variances can indicate areas of inefficiency or opportunities for cost savings. Budgeting also promotes accountability within the organization, as managers are responsible for achieving the budgeted targets and explaining any deviations. Communication and coordination. Budgeting serves as a communication tool, facilitating coordination and collaboration within the organization. It allows different departments or units to align their financial plans and objectives with the overall organizational goals. Budgeting promotes transparency and accountability, as it provides a clear framework for resource allocation and expenditure control. It enables effective communication between managers, employees, and stakeholders, ensuring that everyone is aware of the financial goals and constraints. External stakeholder relations. Budgeting is not only important for internal management but also for external stakeholder relations. Investors, lenders, and other external stakeholders often require organizations to provide budgets and financial forecasts as part of their decision-making process. Budgeting helps in building trust and credibility with external stakeholders by demonstrating financial discipline and transparency. It provides a basis for financial projections and demonstrates the organization's commitment to sound financial management practices. In conclusion, budgeting is a critical component of financial management for organizations of all sizes and types. It enables effective planning, financial control, resource allocation, and decision-making. Budgeting helps organizations set financial goals, monitor performance, manage cash flow, and communicate with internal and external stakeholders. By incorporating budgeting into their financial management processes, organizations can enhance their overall financial performance and achieve long-term success. 8.2 Types of budgets. Budgeting is a crucial aspect of financial management for businesses of all sizes. It involves planning and allocating resources to achieve specific goals and objectives. By creating a budget, businesses can effectively manage their finances, make informed decisions, and monitor their performance. There are various types of budgets that organizations can use to meet their specific needs and requirements. In this section, we will explore some of the most common types of budgets used in accounting. 1. Operating budget. The operating budget is the most common type of budget used by businesses. It focuses on the day-to-day operations and activities of the organization. This budget includes revenue and expense projections for a specific period, usually a year. The operating budget helps businesses plan and control their expenses, set sales targets, and monitor their financial performance. It typically includes budgets for sales, production, marketing, and administrative expenses. 2. Capital budget. A capital budget is used to plan and manage long-term investments in assets such as property, equipment, and technology. This budget helps businesses make informed decisions about capital expenditures and prioritize investment projects. The capital budgeting process involves evaluating the potential return on investment, estimating the costs involved, and determining the feasibility of the projects. By allocating resources to the most promising projects, businesses can maximize their return on investment and ensure the efficient use of capital. 3. Cash budget. A cash budget focuses on the organization's cash flow and helps businesses manage their liquidity. It projects the inflows and outflows of cash over a specific period, usually a month or a quarter. The cash budget takes into account factors such as sales revenue, expenses, loan repayments, and investments. By monitoring their cash flow, businesses can ensure that they have enough cash to meet their obligations, pay their bills on time, and make strategic financial decisions. 4. Master budget. The master budget is an overall budget that combines all the individual budgets of different departments or functions within an organization. It provides a comprehensive view of the organization's financial performance and helps in coordinating the activities of various departments. The master budget includes budgets for sales, production, marketing, administration, and other functional areas. By integrating all the budgets into a single document, businesses can ensure that their financial plans are aligned and consistent. 5. Flexible budget. A flexible budget is designed to adjust to changes in the level of activity or volume of production. It allows businesses to assess their financial performance under different scenarios and levels of activity. A flexible budget is particularly useful in industries where production levels can vary significantly, such as manufacturing or seasonal businesses. By using a flexible budget, businesses can analyze their performance based on actual activity levels and make necessary adjustments to their plans and strategies. 6. Zero-based budget. A zero-based budgeting approach requires businesses to justify and allocate resources from scratch for each budgeting period. Unlike traditional budgeting, where previous budgets serve as a starting point, zero-based budgeting starts from zero and requires a thorough evaluation of all expenses and activities. This approach helps businesses identify unnecessary costs, prioritize resources, and allocate funds based on their value and importance. Zero-based budgeting encourages cost consciousness and can lead to more efficient resource allocation. 7. Incremental budget. An incremental budget is based on the previous period's budget with incremental changes or adjustments. It assumes that the current budget is a reasonable starting point and makes adjustments based on changes in the business environment or objectives. Incremental budgeting is relatively simple and less time-consuming compared to other budgeting methods. However, it may not encourage a thorough evaluation of expenses and can lead to the perpetuation of inefficient or unnecessary costs. 8. Rolling budget. A rolling budget, also known as a continuous budget or a rolling forecast, is a budget that is continuously updated and extended into the future. Instead of creating an annual budget, businesses create a budget for a shorter period, such as a quarter or a month. As each period ends, a new period is added to the budget, ensuring that the budget is always up to date. Rolling budgets allow businesses to adapt to changes in the business environment and make timely adjustments to their plans and strategies. In conclusion, budgeting is a critical tool for businesses to plan, allocate resources, and monitor their financial performance. By understanding the different types of budgets available, businesses can choose the most appropriate budgeting approach based on their specific needs and objectives. Whether it's an operating budget, capital budget, cash budget, or any other type of budget, the key is to align the budget with the organization's goals and regularly review and adjust it as needed. Effective budgeting can help businesses make informed decisions, control costs, and achieve long-term financial success. 8.3 Creating a budget. A budget is a financial plan that outlines the expected income and expenses of a business or individual over a specific period. It serves as a roadmap for managing and allocating resources effectively. Creating a budget is a crucial step in financial planning as it helps businesses and individuals make informed decisions, set financial goals, and track their progress. Importance of budgeting. Budgeting plays a vital role in financial management for several reasons. Goal setting. A budget helps businesses and individuals set financial goals and objectives. It provides a clear picture of what needs to be achieved and serves as a benchmark for measuring success. Resource allocation. By creating a budget, businesses can allocate their resources effectively. It helps in determining how much money should be allocated to different departments or activities, ensuring that funds are distributed in the most efficient manner. Expense control. Budgeting allows businesses and individuals to control their expenses. By setting spending limits and tracking actual expenses against the budgeted amounts, it becomes easier to identify areas where costs can be reduced or eliminated. Cash flow management. A budget helps in managing cash flow effectively. By forecasting income and expenses, businesses can ensure that they have enough cash on hand to cover their obligations and avoid cash flow problems. Decision-making. Budgeting provides valuable information for decision-making. It helps in evaluating the financial feasibility of new projects or investments and enables businesses to make informed decisions based on their financial capabilities. Steps to create a budget. Creating a budget involves several steps that need to be followed systematically. Here are the key steps to create an effective budget. Set financial goals. Start by defining your financial goals. Whether it's increasing revenue, reducing expenses, or saving for a specific purpose, clearly define what you want to achieve through your budget. Gather financial information. Collect all the necessary financial information, including income statements, balance sheets, bank statements, and any other relevant financial documents. This information will help you understand your current financial situation and make accurate projections. Estimate income. Determine your expected income for the budget period. This includes all sources of revenue, such as sales, investments, and any other income streams. Be realistic and conservative while estimating your income. Identify fixed and variable expenses. Differentiate between fixed and variable expenses. Fixed expenses are recurring costs that remain relatively constant, such as rent, utilities, and insurance. Variable expenses, on the other hand, fluctuate based on business activity, such as raw materials, marketing expenses, and employee wages. Project future expenses. Based on historical data and market trends, project your future expenses. Consider both fixed and variable expenses and account for any anticipated changes or upcoming expenses. Allocate funds. Allocate funds to different expense categories based on their priority and importance. Ensure that essential expenses are covered first, and allocate funds for discretionary expenses accordingly. Review and adjust. Review your budget periodically and make necessary adjustments. As circumstances change, you may need to revise your budget to reflect new information or unexpected events. Types of budgets. There are various types of budgets that businesses and individuals can use based on their specific needs and objectives. Some common types of budgets include operating budget. An operating budget focuses on the day-to-day operations of a business. It includes revenue and expense projections for a specific period, such as a month, quarter, or year. Capital budget. A capital budget is used to plan and track investments in long-term assets, such as equipment, buildings, or technology. It helps businesses allocate funds for major capital expenditures and assess the financial viability of such investments. Cash budget. A cash budget focuses on managing cash flow by projecting cash inflows and outflows over a specific period. It helps businesses ensure that they have enough cash on hand to meet their financial obligations. Master budget. A master budget combines various individual budgets, such as the operating budget, capital budget, and cash budget, into a comprehensive financial plan. It provides an overview of the entire financial picture of a business. Monitoring and adjusting the budget. Creating a budget is not a one-time task. It requires continuous monitoring and adjustment to ensure its effectiveness. Here are some key steps to monitor and adjust your budget. Track actual expenses. Regularly compare your actual expenses against the budgeted amounts. This will help you identify any deviations and take corrective actions if necessary. Analyze variances. Analyze the reasons for any significant variances between budgeted and actual amounts. Determine whether the variances are due to changes in business conditions, unexpected expenses, or inaccurate projections. Make adjustments. Based on the analysis of variances, make necessary adjustments to your budget. This may involve reallocating funds, revising expense projections, or setting new financial goals. Communicate and involve stakeholders. Keep stakeholders, such as managers, employees, or family members, informed about the budget and involve them in the monitoring and adjustment process. Their input and feedback can provide valuable insights and improve the effectiveness of the budget. By following these steps and regularly monitoring and adjusting your budget, you can ensure that your financial goals are met, resources are allocated efficiently, and financial stability is maintained. Budgeting is a dynamic process that requires ongoing attention and adaptation to changing circumstances. 8.4 Monitoring and adjusting the budget. Once a budget has been created, it is crucial to monitor and adjust it regularly to ensure that it remains accurate and effective. Monitoring the budget involves comparing actual financial performance against the budgeted amounts and identifying any variances or deviations. Adjusting the budget involves making necessary changes to align it with the current financial situation and business goals. This section will discuss the importance of monitoring and adjusting the budget, as well as the steps involved in this process. Importance of monitoring and adjusting the budget. Monitoring and adjusting the budget is essential for several reasons. Firstly, it allows businesses to track their financial performance and identify any discrepancies between the budgeted and actual amounts. By doing so, they can quickly identify areas where they are overspending or underspending and take appropriate actions to rectify the situation. Secondly, monitoring the budget helps businesses to stay on track and achieve their financial goals. It provides a clear picture of the financial health of the organization and enables management to make informed decisions regarding resource allocation and expenditure control. By regularly reviewing the budget, businesses can identify potential issues or opportunities and take proactive measures to address them. Lastly, adjusting the budget ensures that it remains relevant and realistic. Business conditions are dynamic, and unexpected events or changes in the market can impact financial performance. By regularly reviewing and adjusting the budget, businesses can adapt to these changes and make necessary modifications to their financial plans. Steps in monitoring and adjusting the budget. Monitoring and adjusting the budget involves a systematic approach to ensure accuracy and effectiveness. The following steps outline the process. Collect and analyze financial data. Gather all relevant financial data, including actual revenue and expenses, and compare them against the budgeted amounts. Analyze the variances to identify the reasons behind the discrepancies. Identify variances. Categorize the variances as favorable or unfavorable. Favorable variances occur when actual revenue exceeds budgeted amounts or when actual expenses are lower than budgeted. Unfavorable variances occur when actual revenue falls short of the budgeted amounts or when actual expenses exceed the budget. Investigate the causes. Determine the reasons behind the variances by conducting a thorough analysis. Factors such as changes in market conditions, pricing strategies, production costs, or unexpected events may contribute to the variances. It is essential to identify the root causes to take appropriate corrective actions. Take corrective actions. Based on the analysis, develop strategies to address the variances. If there are favorable variances, consider allocating the excess funds to other areas of the business or investing them for future growth. For unfavorable variances, identify areas where expenses can be reduced or revenue can be increased. Implement cost-cutting measures, revise pricing strategies, or explore new revenue streams. Update the budget. Revise the budget based on the corrective actions taken. Adjust the budgeted amounts to reflect the changes made to the revenue and expense projections. Ensure that the revised budget aligns with the current financial goals and objectives of the business. Communicate and monitor. Share the revised budget with relevant stakeholders, such as department heads or key decision makers. Communicate the changes made and the reasons behind them. Monitor the financial performance regularly to ensure that the revised budget is being followed and that the desired outcomes are being achieved. Review and repeat. Continuously review and repeat the monitoring and adjusting process at regular intervals. Financial conditions and business goals may change over time, requiring further adjustments to the budget. By regularly reviewing and updating the budget, businesses can maintain financial control and make informed decisions. Tools for monitoring and adjusting the budget. Several tools and techniques can assist in monitoring and adjusting the budget effectively. These include financial reports. Regularly review financial statements, such as income statements, balance sheets, and cash flow statements, to track the financial performance of the business. Compare the actual results with the budgeted amounts to identify variances. Key performance indicators (KPIs). Establish KPIs that align with the financial goals of the business. Monitor these indicators regularly to assess performance and identify areas that require attention. Budgeting software. Utilize budgeting software or financial management systems that provide real-time data and automated reporting. These tools can streamline the monitoring and adjusting process, making it more efficient and accurate. Regular meetings and reviews. Conduct regular meetings with department heads or key stakeholders to discuss the budget performance and any necessary adjustments. Review the budget and financial reports together to ensure everyone is on the same page. Benchmarking. Compare the financial performance of the business against industry benchmarks or competitors. This can provide insights into areas where the business is excelling or lagging behind, helping to identify opportunities for improvement. By utilizing these tools and following a systematic approach, businesses can effectively monitor and adjust their budgets to ensure financial stability and success. In conclusion, monitoring and adjusting the budget is a critical aspect of financial management. It allows businesses to track their financial performance, identify variances, and take corrective actions to achieve their financial goals. By following a systematic process and utilizing appropriate tools, businesses can maintain financial control and make informed decisions to drive their success. 9. Financial analysis and ratios. 9.1 Financial ratio analysis. Financial ratio analysis is a powerful tool used by accountants, financial analysts, and investors to assess the financial health and performance of a company. By analyzing various ratios derived from a company's financial statements, stakeholders can gain valuable insights into its profitability, liquidity, solvency, and overall efficiency. These ratios provide a quantitative measure of a company's financial performance and help in making informed decisions. Importance of financial ratio analysis. Financial ratio analysis is crucial for several reasons. Firstly, it allows stakeholders to compare a company's performance over time and against industry benchmarks. By tracking key ratios, such as profitability and liquidity, over different periods, one can identify trends and patterns that may indicate areas of strength or weakness. Secondly, financial ratio analysis helps in assessing a company's ability to meet its short-term and long-term obligations. Liquidity ratios, such as the current ratio and quick ratio, provide insights into a company's ability to pay off its current liabilities using its current assets. Solvency ratios, on the other hand, assess a company's long-term financial stability by measuring its ability to meet long-term debt obligations. Thirdly, financial ratio analysis aids in evaluating a company's profitability. Profitability ratios, such as gross profit margin, operating profit margin, and net profit margin, measure the company's ability to generate profits from its operations. These ratios help stakeholders understand the company's efficiency in managing costs, pricing its products or services, and generating returns for its shareholders. Lastly, financial ratio analysis assists in assessing the efficiency and effectiveness of a company's operations. Activity ratios, such as inventory turnover ratio and accounts receivable turnover ratio, measure how efficiently a company manages its assets and liabilities. These ratios provide insights into the company's inventory management, collection of receivables, and utilization of its assets. Types of financial ratios. Financial ratios can be broadly categorized into four main types: liquidity ratios, profitability ratios, solvency ratios, and efficiency ratios. Liquidity ratios. Liquidity ratios measure a company's ability to meet its short-term obligations. These ratios assess the company's ability to convert its current assets into cash to pay off its current liabilities. Common liquidity ratios include the current ratio, quick ratio, and cash ratio. The current ratio is calculated by dividing current assets by current liabilities. It indicates the company's ability to pay off its short-term obligations using its current assets. A higher current ratio is generally considered favorable, as it suggests a greater ability to meet short-term obligations. The quick ratio, also known as the acid test ratio, is a more stringent measure of liquidity. It excludes inventory from current assets, as inventory may not be easily converted into cash. The quick ratio is calculated by dividing quick assets, current assets minus inventory, by current liabilities. The cash ratio is the most conservative liquidity ratio. It measures the company's ability to pay off its current liabilities using only its cash and cash equivalents. The cash ratio is calculated by dividing cash and cash equivalents by current liabilities. Profitability ratios. Profitability ratios measure a company's ability to generate profits from its operations. These ratios assess the company's efficiency in managing costs, pricing its products or services, and generating returns for its shareholders. Common profitability ratios include gross profit margin, operating profit margin, and net profit margin. The gross profit margin is calculated by dividing gross profit by revenue and represents the percentage of revenue that remains after deducting the cost of goods sold. It indicates how efficiently a company manages its production costs. The operating profit margin measures a company's ability to generate profits from its core operations. It is calculated by dividing operating profit by revenue and represents the percentage of revenue that remains after deducting both the cost of goods sold and operating expenses. The net profit margin is the most comprehensive profitability ratio. It measures the company's ability to generate profits after considering all expenses, including taxes and interest. The net profit margin is calculated by dividing net profit by revenue. Solvency ratios. Solvency ratios measure a company's ability to meet its long-term debt obligations. These ratios assess the company's long-term financial stability and its ability to generate sufficient cash flow to cover its debt payments. Common solvency ratios include debt-to-equity ratio, interest coverage ratio, and debt ratio. The debt-to-equity ratio is calculated by dividing total debt by total equity and represents the proportion of a company's financing that comes from debt. A higher debt-to-equity ratio indicates a higher level of financial risk. The interest coverage ratio measures a company's ability to meet its interest payments using its operating income. It is calculated by dividing operating income by interest expense. A higher interest coverage ratio indicates a greater ability to cover interest payments. The debt ratio measures the proportion of a company's assets that are financed by debt. It is calculated by dividing total debt by total assets. A higher debt ratio indicates a higher level of financial leverage. Efficiency ratios. Efficiency ratios measure how effectively a company utilizes its assets and liabilities to generate revenue. These ratios assess the company's operational efficiency and its ability to manage its resources. Common efficiency ratios include inventory turnover ratio, accounts receivable turnover ratio, and accounts payable turnover ratio. The inventory turnover ratio measures how quickly a company sells its inventory. It is calculated by dividing the cost of goods sold by average inventory. A higher inventory turnover ratio indicates efficient inventory management. The accounts receivable turnover ratio measures how quickly a company collects its accounts receivable. It is calculated by dividing net credit sales by average accounts receivable. A higher accounts receivable turnover ratio indicates efficient collection of receivables. The accounts payable turnover ratio measures how quickly a company pays its suppliers. It is calculated by dividing purchases by average accounts payable. A higher accounts payable turnover ratio indicates efficient payment of bills. Conclusion. Financial ratio analysis is a valuable tool for assessing a company's financial performance and making informed decisions. By analyzing liquidity, profitability, solvency, and efficiency ratios, stakeholders can gain insights into a company's financial health, identify areas of strength or weakness, and compare its performance against industry benchmarks. However, it is important to note that financial ratios should be used in conjunction with other qualitative and quantitative factors to form a comprehensive assessment of a company's financial position. 9.2 Liquidity ratios. Liquidity ratios are financial metrics used to assess a company's ability to meet its short-term obligations and manage its current liabilities. These ratios provide insights into a company's liquidity position and its ability to convert its assets into cash to cover its short-term debts. Liquidity ratios are crucial for both internal management and external stakeholders, such as investors and creditors, as they indicate the financial health and stability of a company. Current ratio. The current ratio is one of the most commonly used liquidity ratios. It measures a company's ability to pay off its short-term liabilities using its current assets. The formula for calculating the current ratio is current ratio equals current assets, current liabilities. A higher current ratio indicates a better liquidity position, as it suggests that a company has sufficient current assets to cover its current liabilities. Generally, a current ratio of 1 or higher is considered favorable, as it implies that a company can meet its short-term obligations without difficulty. However, an excessively high current ratio may indicate that a company is not efficiently utilizing its assets. Quick ratio. The quick ratio, also known as the acid test ratio, is a more stringent measure of liquidity compared to the current ratio. It excludes inventory from current assets, as inventory may not be easily converted into cash in the short term. The formula for calculating the quick ratio is quick ratio equals current assets, inventory, current liabilities. The quick ratio provides a more conservative assessment of a company's ability to meet its short-term obligations. It focuses on the most liquid assets, such as cash, marketable securities, and accounts receivable. A higher quick ratio indicates a stronger liquidity position, as it suggests that a company can cover its current liabilities without relying on the sale of inventory. Generally, a quick ratio of 1 or higher is considered favorable. Cash ratio. The cash ratio is the most conservative liquidity ratio, as it measures a company's ability to pay off its current liabilities using only its cash and cash equivalents. It excludes both inventory and accounts receivable from current assets. The formula for calculating the cash ratio is cash ratio equals cash plus cash equivalents, current liabilities. The cash ratio provides a clear picture of a company's immediate liquidity position. It indicates the extent to which a company can rely on its readily available cash resources to meet its short-term obligations. A higher cash ratio indicates a stronger liquidity position, as it suggests that a company has a significant amount of cash on hand to cover its current liabilities. However, a very high cash ratio may also indicate that a company is not effectively utilizing its cash resources. Operating cash flow ratio. The operating cash flow ratio measures a company's ability to generate sufficient cash flow from its operations to cover its current liabilities. It assesses the cash flow generated by a company's core business activities, excluding financing and investing activities. The formula for calculating the operating cash flow ratio is operating cash flow ratio equals operating cash flow, current liabilities. A higher operating cash flow ratio indicates a stronger ability to generate cash from operations and meet short-term obligations. It suggests that a company's core business activities are generating sufficient cash flow to cover its current liabilities. A ratio of 1 or higher is generally considered favorable, as it indicates that a company can fully cover its current liabilities using its operating cash flow. Interpretation of liquidity ratios. When analyzing liquidity ratios, it is important to consider industry norms and compare a company's ratios to those of its competitors. Different industries have varying liquidity requirements, and what may be considered a favorable ratio in one industry may not be the same in another. Additionally, it is crucial to analyze liquidity ratios in conjunction with other financial metrics and factors. Liquidity ratios provide insights into a company's short-term financial health, but they do not provide a complete picture of its overall financial performance and stability. It is essential to consider other aspects, such as profitability, solvency, and efficiency, to gain a comprehensive understanding of a company's financial position. In conclusion, liquidity ratios are vital tools for assessing a company's ability to meet its short-term obligations. The current ratio, quick ratio, cash ratio, and operating cash flow ratio provide insights into a company's liquidity position and its ability to manage its current liabilities. By analyzing these ratios, stakeholders can make informed decisions regarding investments, lending, and overall financial health. 9.3 Profitability ratios. Profitability ratios are financial metrics used to assess a company's ability to generate profits relative to its expenses and other costs. These ratios provide valuable insights into a company's overall financial performance and its ability to generate returns for its shareholders. By analyzing profitability ratios, investors, creditors, and other stakeholders can evaluate a company's profitability and make informed decisions about its financial health and future prospects. Gross profit margin. The gross profit margin is a profitability ratio that measures the percentage of revenue remaining after deducting the cost of goods sold (COGS). It indicates how efficiently a company is managing its production costs and pricing its products or services. The formula for calculating the gross profit margin is gross profit margin equals revenue, COGS, revenue * 100. A higher gross profit margin indicates that a company is generating more profit from each dollar of revenue. It suggests that the company has effective cost control measures in place or is able to command higher prices for its products or services. Operating profit margin. The operating profit margin measures a company's ability to generate profit from its core operations, excluding non-operating expenses such as interest and taxes. It provides insights into a company's operational efficiency and profitability. The formula for calculating the operating profit margin is operating profit margin equals operating profit, revenue * 100. A higher operating profit margin indicates that a company is generating more profit from its core operations. It suggests that the company is effectively managing its operating expenses and generating a higher return on its sales. Net profit margin. The net profit margin is a profitability ratio that measures the percentage of revenue remaining after deducting all expenses, including operating expenses, interest, taxes, and other non-operating expenses. It provides insights into a company's overall profitability and its ability to generate profit for its shareholders. The formula for calculating the net profit margin is net profit margin equals net profit, revenue * 100. A higher net profit margin indicates that a company is generating more profit from each dollar of revenue. It suggests that the company has effective cost control measures in place, is managing its financial obligations well, and is generating a higher return on its investments. Return on assets (ROA). Return on assets (ROA) is a profitability ratio that measures a company's ability to generate profit from its total assets. It indicates how efficiently a company is utilizing its assets to generate profit. The formula for calculating the return on assets is return on assets (ROA) equals net profit, total assets * 100. A higher ROA indicates that a company is generating more profit from its assets. It suggests that the company is effectively utilizing its resources to generate returns for its shareholders. Return on equity (ROE). Return on equity (ROE) is a profitability ratio that measures a company's ability to generate profit for its shareholders relative to the shareholders' equity. It indicates how effectively a company is utilizing the investments made by its shareholders to generate profit. The formula for calculating the return on equity is return on equity (ROE) equals net profit, shareholders' equity * 100. A higher ROE indicates that a company is generating more profit for its shareholders relative to their investments. It suggests that the company is effectively utilizing the shareholders' equity to generate returns. Earnings per share (EPS). Earnings per share (EPS) is a profitability ratio that measures the amount of profit allocated to each outstanding share of common stock. It provides insights into a company's profitability on a per-share basis and is often used by investors to assess the company's financial performance. The formula for calculating the earnings per share is earnings per share (EPS) equals net profit, number of outstanding shares. A higher EPS indicates that a company is generating more profit for each outstanding share of common stock. It suggests that the company is generating higher returns for its shareholders. Limitations of profitability ratios. While profitability ratios provide valuable insights into a company's financial performance, it is important to consider their limitations. Profitability ratios do not provide a complete picture of a company's financial health and should be used in conjunction with other financial metrics and qualitative factors. Additionally, profitability ratios can be influenced by various factors such as industry norms, economic conditions, and accounting practices. Therefore, it is essential to analyze profitability ratios in the context of the company's industry and compare them with industry benchmarks to gain a more accurate understanding of the company's profitability. In conclusion, profitability ratios are essential tools for evaluating a company's financial performance and profitability. By analyzing these ratios, investors, creditors, and other stakeholders can assess a company's ability to generate profits, manage expenses, and generate returns for its shareholders. However, it is important to consider the limitations of profitability ratios and analyze them in conjunction with other financial metrics to gain a comprehensive understanding of a company's financial health. 9.4 Solvency Ratios. Solvency ratios are financial metrics that assess a company's ability to meet its long-term financial obligations. These ratios provide insights into a company's financial stability and its ability to generate enough cash flow to cover its debts and other long-term liabilities. Solvency ratios are crucial for investors, creditors, and other stakeholders as they help evaluate the risk associated with a company's financial health and its ability to survive in the long run. Debt-to-equity ratio. The debt-to-equity ratio is a commonly used solvency ratio that measures the proportion of a company's total debt to its shareholders' equity. It indicates the extent to which a company relies on debt financing compared to equity financing. The formula for calculating the debt-to-equity ratio is debt-to-equity ratio equals total debt, shareholders' equity. A higher debt-to-equity ratio suggests that a company has a higher level of debt relative to its equity, indicating higher financial risk. On the other hand, a lower ratio indicates a lower level of debt and a more conservative financial structure. It is important to note that the interpretation of this ratio varies across industries, and what may be considered a high ratio in one industry may be normal in another. Debt ratio. The debt ratio, also known as the total debt ratio, measures the proportion of a company's total assets that are financed by debt. It provides an indication of the company's leverage and its ability to withstand financial downturns. The formula for calculating the debt ratio is debt ratio equals total debt, total assets. A higher debt ratio indicates a higher level of debt relative to the company's assets, suggesting a higher financial risk. Conversely, a lower debt ratio indicates a lower level of debt and a more conservative financial structure. Interest coverage ratio. The interest coverage ratio, also known as the times interest earned ratio, assesses a company's ability to meet its interest payments on its outstanding debt. It measures the company's ability to generate enough operating income to cover its interest expenses. The formula for calculating the interest coverage ratio is interest coverage ratio equals operating income, interest expense. A higher interest coverage ratio indicates that a company is generating sufficient operating income to cover its interest expenses, suggesting a lower risk of default. Conversely, a lower ratio suggests that the company may struggle to meet its interest obligations, indicating a higher risk of financial distress. Debt service coverage ratio. The debt service coverage ratio (DSCR) is a solvency ratio that evaluates a company's ability to meet its debt obligations, including both principal and interest payments. It measures the company's cash flow available to cover its debt service requirements. The formula for calculating the DSCR is DSCR equals operating income, total debt service. A DSCR greater than 1 indicates that the company generates enough cash flow to cover its debt service obligations, suggesting a lower risk of default. A DSCR less than 1 indicates that the company may struggle to meet its debt obligations, indicating a higher risk of financial distress. Cash flow to debt ratio. The cash flow to debt ratio measures a company's ability to generate sufficient cash flow to cover its total debt. It provides insights into the company's ability to generate cash flow from its operations to meet its debt obligations. The formula for calculating the cash flow to debt ratio is cash flow to debt ratio equals operating cash flow, total debt. A higher cash flow to debt ratio indicates that the company generates enough cash flow to cover its total debt, suggesting a lower risk of default. Conversely, a lower ratio suggests that the company may struggle to generate sufficient cash flow to meet its debt obligations, indicating a higher risk of financial distress. Conclusion. Solvency ratios are essential tools for assessing a company's long-term financial health and its ability to meet its financial obligations. These ratios provide valuable insights into a company's financial stability and its capacity to generate cash flow to cover its debts and other long-term liabilities. Investors, creditors, and other stakeholders use solvency ratios to evaluate the risk associated with a company's financial position and make informed decisions about their investments or lending decisions. By analyzing solvency ratios, stakeholders can gain a better understanding of a company's financial strength and its ability to weather financial challenges in the long run. 10. Cost accounting. 10.1 Cost classification. Cost classification is an essential aspect of cost accounting, as it involves categorizing costs into different groups based on their characteristics and behavior. By classifying costs, businesses can gain a better understanding of their cost structure, make informed decisions, and effectively manage their resources. In this section, we will explore the different types of cost classification and their significance in financial analysis and decision-making. Fixed costs. Fixed costs are expenses that remain constant regardless of the level of production or sales volume. These costs do not vary with changes in activity levels and are incurred regardless of whether the business is operating at full capacity or not. Examples of fixed costs include rent, insurance premiums, salaries of permanent employees, and depreciation of fixed assets. Fixed costs are crucial for businesses to cover their basic operational expenses and maintain a stable cost structure. Since they do not change with production levels, fixed costs per unit decrease as production increases, leading to economies of scale. Understanding fixed costs is essential for determining the break-even point, which is the level of sales or production at which total revenue equals total costs. Variable costs. Variable costs, as the name suggests, vary in direct proportion to changes in production or sales volume. These costs increase or decrease as the level of activity changes. Examples of variable costs include raw materials, direct labor, packaging, and sales commissions. Variable costs are directly linked to the production process and are incurred only when there is a corresponding increase in activity. They are essential for calculating the cost of goods sold, COGS, and determining the profitability of each unit produced or sold. By analyzing variable costs, businesses can assess the impact of changes in production levels on their overall cost structure and profitability. Semi-variable costs. Semi-variable costs, also known as mixed costs, have characteristics of both fixed and variable costs. These costs have a fixed component that remains constant over a certain range of activity levels and a variable component that changes with changes in activity. Examples of semi-variable costs include utility bills, telephone expenses, and maintenance costs. Semi-variable costs pose a challenge in cost classification as they require a more detailed analysis to separate the fixed and variable components. This separation is crucial for accurate cost estimation and decision-making. By understanding the fixed and variable portions of semi-variable costs, businesses can better allocate resources and plan for future expenses. Direct costs. Direct costs are expenses that can be directly traced to a specific product, service, or cost object. These costs are incurred solely for the production or acquisition of a particular item and can be easily allocated to that item. Examples of direct costs include direct materials, direct labor, and direct expenses. Direct costs are essential for calculating the cost of goods sold, COGS, and determining the profitability of individual products or services. By accurately identifying and tracking direct costs, businesses can assess the profitability of each product line, make pricing decisions, and evaluate the performance of different cost centers. Indirect costs. Indirect costs, also known as overhead costs, are expenses that cannot be directly attributed to a specific product or service. These costs are incurred for the overall operation of the business and are shared among multiple cost objects. Examples of indirect costs include rent, utilities, administrative salaries, and depreciation of shared assets. Indirect costs are allocated to different cost objects using cost allocation methods such as activity-based costing, ABC, or predetermined overhead rates. By allocating indirect costs, businesses can determine the total cost of each product or service, assess the profitability of different cost centers, and make informed decisions regarding resource allocation and pricing. Opportunity costs. Opportunity costs are the potential benefits or profits that are foregone when one alternative is chosen over another. These costs represent the value of the next best alternative that is sacrificed in favor of the chosen option. Opportunity costs are not recorded in the financial statements but are crucial for decision-making and evaluating the benefits of different choices. By considering opportunity costs, businesses can assess the potential benefits of alternative courses of action and make informed decisions. For example, when deciding whether to invest in a new project, businesses need to evaluate the potential returns of the project compared to the returns that could be achieved by investing in other opportunities. Conclusion. Cost classification plays a vital role in cost accounting and financial analysis. By categorizing costs into different groups based on their behavior and characteristics, businesses can gain valuable insights into their cost structure, make informed decisions, and effectively manage their resources. Understanding the different types of costs and their significance in financial analysis is essential for businesses to achieve profitability and sustainable growth. 10.2 Cost behavior. Cost behavior refers to how costs change in relation to changes in the level of activity or volume of production. Understanding cost behavior is crucial for effective cost management and decision-making within an organization. By analyzing how costs behave, managers can make informed decisions regarding pricing, production levels, and resource allocation. Fixed costs. Fixed costs are expenses that do not change with the level of production or sales volume. These costs remain constant regardless of whether the company produces 1 unit or 1 million units. Examples of fixed costs include rent, salaries of permanent employees, insurance premiums, and property taxes. One characteristic of fixed costs is that they are incurred even if there is no production or sales activity. For example, a company must still pay rent for its office space, regardless of whether it is producing or selling any products. Fixed costs are often associated with the infrastructure and ongoing operations of a business. From a cost behavior perspective, fixed costs per unit decrease as production volume increases. This is because the fixed costs are spread over a larger number of units, resulting in a lower cost per unit. However, the total fixed costs remain constant. Variable costs. Variable costs, on the other hand, change in direct proportion to changes in the level of production or sales volume. These costs increase or decrease as the volume of activity changes. Examples of variable costs include direct materials, direct labor, and sales commissions. Variable costs are incurred only when there is production or sales activity. For example, the cost of raw materials is only incurred when the company is producing goods. Variable costs are often associated with the direct costs of producing a product or delivering a service. From a cost behavior perspective, variable costs per unit remain constant regardless of the production volume. However, the total variable costs increase or decrease in direct proportion to the level of activity. As more units are produced or sold, the total variable costs increase, and vice versa. Semi-variable costs. Semi-variable costs, also known as mixed costs, have both fixed and variable components. These costs have a fixed portion that remains constant regardless of the level of activity, and a variable portion that changes with the level of activity. Examples of semi-variable costs include utilities, telephone bills, and maintenance costs. For semi-variable costs, the fixed portion is incurred regardless of the level of activity, while the variable portion increases or decreases with the level of activity. For example, a company may have a fixed monthly fee for telephone services, but the variable portion of the bill increases as more calls are made. Analyzing the behavior of semi-variable costs can be more complex than fixed or variable costs. Managers need to separate the fixed and variable components to accurately understand the cost behavior and make informed decisions. Step costs. Step costs are a type of semi-variable cost that change abruptly at certain levels of activity. These costs remain constant within a specific range of activity but increase or decrease when the activity level crosses a threshold. Examples of step costs include hiring additional employees, purchasing new equipment, or expanding production capacity. Step costs are characterized by a step-like pattern, where the cost remains constant within a range and then jumps to a new level when the activity level exceeds the threshold. This cost behavior is often associated with the need to make significant investments or changes in resources to accommodate increased production or sales. Understanding step costs is essential for capacity planning and determining the most cost-effective production levels. By identifying the thresholds and associated costs, managers can make informed decisions about when to increase capacity or adjust resources. Cost behavior analysis. Analyzing cost behavior is crucial for effective cost management and decision-making. By understanding how costs behave, managers can make informed decisions regarding pricing, production levels, and resource allocation. Cost behavior analysis involves identifying the fixed, variable, semi-variable, and step costs within an organization. One common tool used in cost behavior analysis is the cost volume profit (CVP) analysis. CVP analysis examines the relationship between costs, volume, and profit to determine the break-even point and assess the impact of changes in volume on profitability. This analysis helps managers understand the cost structure of the business and make informed decisions about pricing, production levels, and sales strategies. In conclusion, cost behavior refers to how costs change in relation to changes in the level of activity or volume of production. Understanding cost behavior is crucial for effective cost management and decision-making within an organization. By analyzing fixed costs, variable costs, semi-variable costs, and step costs, managers can make informed decisions regarding pricing, production levels, and resource allocation. Cost behavior analysis, including tools like cost volume profit analysis, helps managers understand the cost structure of the business and make informed decisions about profitability. 10.3 Cost volume profit analysis. Cost volume profit (CVP) analysis is a powerful tool used by businesses to understand the relationship between costs, volume, and profit. It helps managers make informed decisions regarding pricing, production levels, and sales strategies. By analyzing the impact of changes in these variables, businesses can determine their break-even point, target profit levels, and assess the profitability of different products or services. Understanding cost volume profit analysis. Cost volume profit analysis is based on several key assumptions. Firstly, it assumes that the selling price per unit, variable cost per unit, and fixed costs remain constant. While this may not always be the case in reality, CVP analysis provides a useful starting point for decision-making. It also assumes that the production and sales mix remains constant, and that the analysis is conducted within a relevant range of activity. The analysis involves the calculation of various metrics, including the break-even point, contribution margin, and the margin of safety. These metrics provide valuable insights into the financial health and profitability of a business. Break-even point. The break-even point is a fundamental concept in CVP analysis. It represents the level of sales at which a business neither makes a profit nor incurs a loss. At this point, total revenue equals total costs. The break-even point can be calculated in units or dollars. To calculate the break-even point in units, divide the fixed costs by the contribution margin per unit. The contribution margin is the difference between the selling price per unit and the variable cost per unit. This calculation provides the number of units that need to be sold to cover all fixed costs. In dollars, the break-even point can be calculated by dividing the fixed costs by the contribution margin ratio. The contribution margin ratio is the contribution margin per unit divided by the selling price per unit. This calculation provides the dollar amount of sales needed to cover all fixed costs. The break-even point is a crucial reference point for businesses. It helps determine the minimum level of sales required to cover costs and avoid losses. Beyond the break-even point, each additional unit sold contributes to profit. Contribution margin. The contribution margin is a key metric in CVP analysis. It represents the amount of revenue available to cover fixed costs and contribute to profit after deducting variable costs. The contribution margin can be calculated per unit or as a ratio. To calculate the contribution margin per unit, subtract the variable cost per unit from the selling price per unit. This calculation provides the amount of revenue available to cover fixed costs for each unit sold. The contribution margin ratio is calculated by dividing the contribution margin per unit by the selling price per unit. This ratio represents the proportion of each dollar of sales that contributes to covering fixed costs and profit. The contribution margin is a useful indicator of the profitability of a product or service. A higher contribution margin indicates that a larger proportion of each sale contributes to covering fixed costs and generating profit. Margin of safety. The margin of safety is another important concept in CVP analysis. It measures the extent to which actual sales exceed the break-even point. It provides a cushion for businesses, indicating how much sales can decline before losses are incurred. The margin of safety can be calculated in units or as a ratio. In units, it is calculated by subtracting the break-even point from the actual sales volume. This calculation provides the number of units that can be lost before losses occur. As a ratio, the margin of safety is calculated by dividing the margin of safety in units by the actual sales volume. This ratio represents the proportion of sales that exceeds the break-even point. A higher margin of safety indicates that a business is better positioned to withstand fluctuations in sales volume and still remain profitable. It provides a measure of stability and flexibility in the face of uncertainty. Using cost-volume profit analysis. Cost-volume profit analysis provides valuable insights for decision-making in various areas of business. Here are some practical applications. Pricing decisions. CVP analysis helps determine the optimal selling price by considering the impact on costs, volume, and profit. It helps businesses strike a balance between maximizing revenue and covering costs. Product mix decisions. By analyzing the contribution margin of different products or services, businesses can identify the most profitable offerings. This information can guide decisions regarding resource allocation and marketing strategies. Sales volume planning. CVP analysis helps businesses set realistic sales targets and assess the feasibility of achieving them. It provides a framework for evaluating the impact of changes in sales volume on profitability. Cost control. By understanding the relationship between costs and volume, businesses can identify opportunities for cost reduction. CVP analysis highlights the impact of changes in volume on fixed and variable costs. Break-even analysis. CVP analysis helps businesses determine the break-even point and assess the financial viability of new projects or ventures. It provides a clear understanding of the minimum sales required to cover costs. In conclusion, cost-volume profit analysis is a powerful tool that enables businesses to understand the relationship between costs, volume, and profit. By analyzing these variables, businesses can make informed decisions regarding pricing, production levels, and sales strategies. CVP analysis provides valuable insights into the break-even point, contribution margin, and margin of safety, which are essential for assessing profitability and financial health. 10.4 Job order costing and process costing. In the world of accounting, there are various methods used to allocate costs to products or services. Two commonly used methods are job order costing and process costing. These methods are essential for businesses to accurately determine the cost of producing goods or providing services. In this section, we will explore the differences between job order costing and process costing, their applications, and how they are implemented. Job order costing. Job order costing is a cost allocation method used when products or services are produced on a customized or individual basis. It is commonly employed in industries such as construction, printing, and custom manufacturing. In job order costing, costs are assigned to specific jobs or projects, allowing businesses to track the expenses associated with each job separately. The process of job order costing begins with the creation of a job cost sheet. This sheet contains detailed information about the job, including the materials, labor, and overhead costs incurred. As the job progresses, additional costs are added to the job cost sheet. At the completion of the job, the total costs are calculated and divided by the number of units produced to determine the cost per unit. Job order costing provides businesses with valuable information about the profitability of individual jobs. It allows them to assess the costs associated with each job and make informed decisions regarding pricing, resource allocation, and future job estimates. Additionally, job order costing enables businesses to accurately track costs for billing purposes and to meet customer requirements. Process costing. Process costing, on the other hand, is used when products or services are produced in a continuous, repetitive manner. It is commonly employed in industries such as food processing, chemical manufacturing, and oil refining. In process costing, costs are allocated to each production process or department rather than to individual jobs or projects. The process of process costing involves the accumulation of costs for each production process or department. These costs include direct materials, direct labor, and overhead expenses. The total costs for each process or department are then divided by the number of units produced to determine the cost per unit. Process costing provides businesses with a comprehensive view of the costs incurred in each production process or department. It allows them to analyze the efficiency and effectiveness of their operations, identify areas for improvement, and make informed decisions regarding pricing and resource allocation. Process costing is particularly useful in industries where products or services undergo multiple stages of production. Key differences. While both job order costing and process costing are used to allocate costs, there are several key differences between the two methods. The main differences lie in the nature of the products or services being produced and the level of cost detail required. Job order costing is used for customized or individualized products or services, where costs can be directly traced to specific jobs. It provides a higher level of cost detail and allows businesses to assess the profitability of each job separately. On the other hand, process costing is used for continuous or repetitive production processes, where costs are allocated to each process or department. It provides a broader view of costs and is more suitable for industries with standardized production processes. Another difference is the timing of cost allocation. In job order costing, costs are allocated to specific jobs as they are incurred. In process costing, costs are accumulated for each process or department over a specific period, such as a month or a quarter. This difference in timing allows businesses to monitor costs and make adjustments accordingly. Implementation and challenges. Implementing job order costing and process costing requires careful planning and accurate record keeping. Businesses need to establish a system for tracking costs, assigning costs to jobs or processes, and calculating the cost per unit. This often involves the use of specialized software or accounting systems. One of the challenges in job order costing is accurately estimating the costs associated with each job. This requires a thorough understanding of the resources required, the time involved, and the overhead expenses. Estimating costs too low can result in reduced profitability, while estimating costs too high can make the business less competitive. In process costing, the challenge lies in accurately allocating costs to each process or department. This requires a clear understanding of the cost drivers and the ability to accurately measure the output of each process. Failure to allocate costs correctly can lead to distorted cost information and inaccurate decision-making. Overall, job order costing and process costing are valuable tools in the accounting toolbox. They provide businesses with the ability to accurately determine the cost of producing goods or providing services, make informed decisions, and assess the profitability of their operations. By understanding the differences between these methods and implementing them effectively, businesses can gain a competitive edge in the numbers game of accounting. 11. Taxation and tax planning. 11.1 Types of taxes. Taxes are an essential part of any economy, providing the government with the necessary funds to carry out its functions and provide public goods and services. As an accountant, it is crucial to have a comprehensive understanding of the different types of taxes that individuals and businesses are required to pay. This section will explore the various types of taxes commonly encountered in accounting. Income tax. Income tax is one of the most well-known and significant types of taxes. It is imposed on the income earned by individuals, corporations, and other entities. The tax rate is typically progressive, meaning that higher income earners are subject to a higher tax rate. Income tax is usually calculated based on the taxable income, which is the income after deducting allowable expenses and exemptions. Sales tax. Sales tax is a consumption-based tax imposed on the sale of goods and services. It is typically levied as a percentage of the purchase price and is collected by the seller at the point of sale. The tax rate and regulations vary from jurisdiction to jurisdiction. In some countries, sales tax is referred to as value-added tax (VAT). Property tax. Property tax is a tax imposed on the value of real estate or personal property. It is usually levied by local governments and used to fund public services such as schools, roads, and public safety. The tax amount is determined based on the assessed value of the property, which is determined by the local tax assessor. Payroll tax. Payroll tax is a tax imposed on wages and salaries paid by employers and employees. It is used to fund social security programs, such as retirement benefits, disability insurance, and healthcare. The tax is typically calculated as a percentage of the employee's wages, and both the employer and employee are responsible for paying their share of the tax. Excise tax. Excise tax is a tax imposed on specific goods and services, such as alcohol, tobacco, gasoline, and luxury items. It is often referred to as a sin tax, because it is intended to discourage the consumption of certain products. Excise tax can be levied as a specific amount per unit or as a percentage of the purchase price. Estate and gift tax. Estate and gift tax are taxes imposed on the transfer of wealth from one person to another. Estate tax is levied on the total value of a deceased person's estate before it is distributed to heirs, while gift tax is imposed on the transfer of property during a person's lifetime. These taxes are designed to prevent the accumulation of wealth in a few hands and promote a more equitable distribution of wealth. Corporate tax. Corporate tax is a tax imposed on the profits earned by corporations. It is calculated based on the net income of the company after deducting allowable expenses and exemptions. The tax rate for corporate tax is usually different from the tax rate for individual income tax. Import and export duties. Import and export duties, also known as customs duties or tariffs, are taxes imposed on goods imported into or exported out of a country. These taxes are designed to protect domestic industries, regulate trade, and generate revenue for the government. The tax amount is typically calculated as a percentage of the value of the goods. Capital gains tax. Capital gains tax is a tax imposed on the profit earned from the sale of an asset, such as stocks, bonds, real estate, or artwork. The tax is calculated based on the difference between the purchase price and the selling price of the asset. The tax rate for capital gains can vary depending on the holding period of the asset and the taxpayer's income level. Inheritance tax. Inheritance tax is a tax imposed on the value of assets inherited by an individual after someone's death. The tax rate and exemptions vary depending on the jurisdiction. In some countries, inheritance tax is combined with estate tax. Understanding the different types of taxes is crucial for accountants as they play a vital role in ensuring compliance with tax laws and regulations. By having a comprehensive knowledge of these taxes, accountants can assist individuals and businesses in managing their tax obligations effectively and optimizing their tax strategies. 11.2 Tax Planning Strategies. Tax planning is an essential aspect of financial management for individuals and businesses alike. It involves making strategic decisions and taking advantage of available tax incentives and deductions to minimize tax liabilities legally. Effective tax planning can help individuals and businesses optimize their financial resources, increase savings, and achieve their financial goals. In this section, we will explore some common tax planning strategies that individuals and businesses can employ to reduce their tax burden. 1. Income shifting. Income shifting is a tax planning strategy that involves redistributing income among family members or entities to take advantage of lower tax brackets or tax rates. This strategy is commonly used by high-income individuals or business owners to reduce their overall tax liability. By shifting income to family members with lower incomes, the tax burden can be significantly reduced. For example, a business owner can hire family members and pay them a reasonable salary for the work they perform. This allows the business owner to deduct the salary as a business expense while shifting income to family members who may be in a lower tax bracket. However, it is important to ensure that the income shifting is done legitimately and that the family members are actually providing services to the business. 2. Retirement contributions. Contributing to retirement accounts is not only a smart financial move for securing future financial stability but also a tax-efficient strategy. Contributions to retirement accounts such as 401ks, IRAs, and SEP IRAs are typically tax-deductible, reducing the taxable income for the year. By maximizing contributions to these accounts, individuals can lower their taxable income and potentially move into a lower tax bracket. Additionally, some retirement accounts offer tax-deferred growth, meaning that the investment earnings are not taxed until they are withdrawn during retirement. This allows individuals to potentially grow their retirement savings more quickly by reinvesting the tax savings. 3. Capital gains and losses. Capital gains and losses refer to the profits or losses realized from the sale of assets such as stocks, bonds, real estate, or other investments. By strategically managing capital gains and losses, individuals can minimize their tax liability. One tax planning strategy is to offset capital gains with capital losses. If an individual has realized capital losses during the year, they can use those losses to offset any capital gains, reducing the overall taxable income. If the capital losses exceed the capital gains, individuals can use the excess losses to offset up to $3,000 of ordinary income. Any remaining losses can be carried forward to future years. Another strategy is to take advantage of the preferential tax rates for long-term capital gains. By holding onto investments for more than 1 year before selling, individuals can qualify for lower tax rates on the gains. This can result in significant tax savings, especially for individuals in higher tax brackets. 4. Tax-advantaged investments. Investing in tax-advantaged vehicles can be an effective tax planning strategy. These investments offer specific tax benefits that can help reduce tax liabilities. Some common tax-advantaged investments include municipal bonds, health savings accounts (HSAs), and 529 college savings plans. Municipal bonds, also known as munis, are issued by state and local governments and offer tax-free interest income at the federal level. Investing in municipal bonds can be particularly beneficial for individuals in higher tax brackets. HSAs are another tax-advantaged investment option. Contributions to HSAs are tax-deductible, and the earnings grow tax-free. Withdrawals from HSAs are also tax-free if used for qualified medical expenses. HSAs provide individuals with a triple tax advantage, making them an attractive option for both healthcare savings and tax planning. 529 college savings plans are designed to help individuals save for education expenses. Contributions to these plans are not tax-deductible at the federal level, but the earnings grow tax-free. Withdrawals from 529 plans are also tax-free if used for qualified education expenses. These plans offer individuals a tax-efficient way to save for their children's education. 5. Charitable contributions. Charitable contributions not only support worthy causes but also provide tax benefits. Donations to qualified charitable organizations are tax-deductible, meaning they can reduce taxable income. By strategically planning charitable contributions, individuals can maximize their tax savings. It is important to keep proper documentation of charitable contributions, including receipts or acknowledgement letters from the charitable organizations. The documentation should include the name of the organization, the date of the contribution, and the amount donated. For larger donations, additional requirements may apply, such as appraisals for donated property. 6. Business expense deductions. For businesses, maximizing deductions for legitimate business expenses is a key tax planning strategy. By properly tracking and documenting business expenses, businesses can reduce their taxable income and lower their overall tax liability. Common deductible business expenses include rent, utilities, office supplies, travel expenses, professional fees, and employee wages. It is important to consult with a tax professional or refer to the IRS guidelines to ensure that all expenses meet the necessary criteria for deduction. 7. Tax credits. Tax credits are powerful tools for reducing tax liabilities as they directly offset the amount of tax owed. Unlike deductions, which reduce taxable income, tax credits provide a dollar-for-dollar reduction in the tax liability. There are various tax credits available to individuals and businesses, such as the Earned Income Tax Credit, EITC, Child Tax Credit, and Energy Efficiency Tax Credits. These credits can significantly reduce tax liabilities and, in some cases, result in a refund even if no taxes were owed. To take advantage of tax credits, individuals and businesses must meet specific eligibility criteria and follow the guidelines outlined by the IRS. It is important to stay informed about available tax credits and consult with a tax professional to ensure proper utilization. Conclusion. Tax planning strategies play a crucial role in minimizing tax liabilities and maximizing financial resources. By employing effective tax planning strategies, individuals and businesses can optimize their financial situations, increase savings, and achieve their financial goals. It is important to stay informed about changes in tax laws and consult with a tax professional to ensure compliance and maximize tax savings. 11.3 Tax deductions and credits. Tax deductions and credits play a crucial role in reducing the amount of tax individuals and businesses owe to the government. By taking advantage of these deductions and credits, taxpayers can lower their taxable income and potentially save a significant amount of money. In this section, we will explore the concept of tax deductions and credits, how they differ from each other, and the various types available. Understanding tax deductions. Tax deductions are expenses or costs that individuals and businesses can subtract from their taxable income, thereby reducing the amount of income subject to taxation. Deductions are typically categorized as either above the line or below the line deductions. Above the line deductions. Above the line deductions, also known as adjustments to income, are deductions that taxpayers can claim regardless of whether they itemize their deductions or take the standard deduction. These deductions are subtracted from the taxpayer's gross income, resulting in the adjusted gross income (AGI). Some common above-the-line deductions include educator expenses. Teachers can deduct certain out-of-pocket expenses related to their profession. Student loan interest. Taxpayers can deduct the interest paid on qualified student loans. Health savings account (HSA) contributions. Contributions made to an HSA are tax deductible. Self-employment taxes. Self-employed individuals can deduct the employer portion of their self-employment taxes. Contributions to retirement accounts. Contributions made to traditional IRAs or employer-sponsored retirement plans may be tax deductible. Below-the-line deductions. Below-the-line deductions, also known as itemized deductions, are deductions that taxpayers can claim if they choose to itemize their deductions instead of taking the standard deduction. Itemized deductions are subtracted from the taxpayer's AGI, resulting in the taxable income. Some common below-the-line deductions include state and local taxes. Taxpayers can deduct state and local income taxes or sales taxes paid. Mortgage interest, deducting the interest paid on a mortgage loan for a primary or secondary residence. Charitable contributions. Contributions made to qualified charitable organizations are deductible. Medical expenses. Deducting qualified medical expenses that exceed a certain percentage of the taxpayer's AGI. Casualty and theft losses. Deducting losses due to theft, fire, or other disasters not covered by insurance. Exploring tax credits. Unlike tax deductions, which reduce taxable income, tax credits directly reduce the amount of tax owed. Tax credits are typically more valuable than deductions since they provide a dollar-for-dollar reduction in tax liability. Let's explore some common types of tax credits. Child tax credit. The child tax credit is a credit available to taxpayers who have dependent children under the age of 17. For each qualifying child, taxpayers can claim a credit of up to $2,000. The credit reduces the taxpayer's tax liability, and if the credit exceeds the tax owed, a portion may be refundable. Earned Income Tax Credit (EITC). The Earned Income Tax Credit is a refundable credit designed to assist low to moderate income individuals and families. The credit amount depends on the taxpayer's income, filing status, and the number of qualifying children. The EITC can result in a significant refund for eligible taxpayers. Education credits. There are two main education credits available to taxpayers. American Opportunity Credit, This credit provides up to $2,500 per eligible student for qualified education expenses incurred during the first 4 years of post-secondary education. Lifetime Learning Credit. Taxpayers can claim a credit of up to $2,000 per tax return for qualified education expenses incurred throughout their lifetime. Renewable Energy Credits. To encourage the use of renewable energy sources, the government offers tax credits for individuals and businesses that invest in renewable energy systems such as solar panels or wind turbines. These credits can offset a portion of the costs associated with installing and using renewable energy sources. Maximizing tax savings. To maximize tax savings, it is essential to identify and take advantage of all available deductions and credits. Here are a few strategies to consider. Keep detailed records. Maintain accurate records of all expenses and transactions that may qualify for deductions or credits. Consult a tax professional. Seek guidance from a qualified tax professional who can help identify potential deductions and credits specific to your situation. Stay informed. Stay updated on changes to tax laws and regulations to ensure you are aware of new deductions or credits that may be available. Plan ahead. Consider timing certain expenses or investments to maximize deductions or credits in a particular tax year. Review eligibility criteria. Understand the eligibility requirements for each deduction or credit to ensure you meet the necessary criteria. By understanding the different types of tax deductions and credits available and implementing effective tax planning strategies, individuals and businesses can minimize their tax liability and keep more of their hard-earned money. It is important to consult with a tax professional or refer to the IRS guidelines for specific details and requirements related to deductions and credits. 11.4 Tax Compliance and Reporting. Tax compliance and reporting are essential aspects of accounting that businesses must adhere to in order to meet their legal obligations and maintain financial transparency. This section will explore the importance of tax compliance, the various tax reporting requirements, and the consequences of non-compliance. Importance of tax compliance. Tax compliance refers to the process of accurately and timely fulfilling all tax obligations imposed by the government. It is crucial for businesses to comply with tax laws to avoid penalties, fines, and legal consequences. Additionally, tax compliance helps maintain the integrity of financial records and ensures that businesses contribute their fair share to the government's revenue. Complying with tax regulations also helps businesses build a positive reputation and maintain good relationships with tax authorities. It demonstrates transparency and ethical behavior, which can enhance trust among stakeholders, including investors, lenders, and customers. Tax reporting requirements. Tax reporting involves the preparation and submission of various documents and forms to the tax authorities. The specific requirements vary depending on the jurisdiction and the type of business entity. Here are some common tax reporting requirements. Income tax return. Businesses are typically required to file an annual income tax return, reporting their income, deductions, and tax liability. The form and deadlines may vary based on the business structure, such as sole proprietorship, partnership, corporation, or limited liability company. Sales tax return. If a business sells taxable goods or services, it may be required to collect and remit sales tax to the appropriate tax authority. Sales tax returns are usually filed on a regular basis, such as monthly, quarterly, or annually, depending on the jurisdiction. Payroll tax reporting. Businesses with employees must report and remit payroll taxes, including income tax withholding, Social Security tax, and Medicare tax. Employers are responsible for accurately calculating and reporting these taxes on a regular basis. Information returns. Certain transactions, such as payments to independent contractors or interest income, may require the filing of information returns. These forms, such as Form 1099 in the United States, provide the tax authorities with details of these transactions. Value-added tax (VAT) returns. In countries with a value-added tax system, businesses may need to file periodic VAT returns, reporting their sales, purchases, and VAT liability. These returns help determine the amount of VAT owed or refundable. Estimated tax payments. If a business is expected to owe a significant amount of tax at the end of the year, it may be required to make estimated tax payments throughout the year. These payments help businesses meet their tax obligations and avoid penalties for underpayment. Consequences of non-compliance. Failure to comply with tax laws can have serious consequences for businesses. Some of the potential consequences of non-compliance include penalties and fines. Tax authorities may impose penalties and fines for later incorrect filings, underpayment of taxes, or failure to file altogether. These penalties can accumulate over time and significantly impact a business's financial health. Interest charges. If taxes are not paid on time, tax authorities may charge interest on the outstanding amount. This can further increase the financial burden on businesses. Audits and investigations. Non-compliance with tax laws can trigger audits or investigations by tax authorities. These processes can be time-consuming, costly, and may result in additional penalties if discrepancies or intentional tax evasion is discovered. Reputation damage. Non-compliance with tax laws can damage a business's reputation and erode trust among stakeholders. This can have long-term consequences, including loss of customers, investors, and business opportunities. Legal consequences. In severe cases of tax evasion or fraud, businesses and individuals may face criminal charges, leading to fines, imprisonment, or both. Legal consequences can have a lasting impact on the business's operations and the personal lives of those involved. Ensuring tax compliance. To ensure tax compliance, businesses should implement effective tax planning strategies and maintain accurate financial records. Here are some key steps to help businesses stay compliant. Stay informed. Stay updated on changes in tax laws and regulations that may affect the business. Consult with tax professionals or seek guidance from tax authorities to ensure accurate interpretation and application of tax laws. Maintain accurate records. Keep detailed records of all financial transactions, including income, expenses, and supporting documentation. Accurate records make it easier to prepare tax returns and respond to any inquiries from tax authorities. Use reliable accounting software. Utilize accounting software that can help automate tax calculations, generate accurate financial reports, and facilitate tax compliance. These tools can streamline the tax reporting process and minimize errors. Seek professional assistance. Engage the services of qualified tax professionals, such as accountants or tax advisors, to ensure compliance with tax laws. They can provide expert advice, assist with tax planning, and help prepare and review tax returns. File and pay taxes on time. Adhere to tax filing deadlines and make timely payments to avoid penalties and interest charges. Set up reminders or utilize tax software that can help track deadlines and automate tax payments. Monitor changes in tax laws. Regularly review and assess the impact of any changes in tax laws on the business's tax obligations. Adjust tax planning strategies accordingly to ensure ongoing compliance. By prioritizing tax compliance and implementing effective tax planning strategies, businesses can navigate the complex landscape of tax regulations and fulfill their obligations while minimizing the risk of penalties and legal consequences. 12. Ethics in accounting. 12.1 Professional ethics in accounting. Ethics play a crucial role in the field of accounting. As professionals entrusted with financial information, accountants have a responsibility to uphold ethical standards to ensure the integrity and reliability of financial reporting. In this section, we will explore the importance of professional ethics in accounting and discuss the key principles that guide ethical behavior in the profession. The importance of professional ethics. Professional ethics serve as a foundation for the accounting profession, providing a framework for accountants to make ethical decisions and maintain public trust. Ethical behavior is essential in accounting for several reasons. Integrity and trust. Ethical behavior builds trust between accountants, clients, and stakeholders. When accountants act with integrity, they demonstrate their commitment to honesty, transparency, and accuracy in financial reporting. Credibility. Ethical behavior enhances the credibility of financial information. Stakeholders rely on accurate and reliable financial statements to make informed decisions. By adhering to ethical standards, accountants contribute to the credibility of financial reporting. Legal compliance. Ethical behavior ensures compliance with laws and regulations governing financial reporting. Accountants must adhere to professional codes of conduct and follow legal requirements to avoid legal consequences and maintain their professional standing. Professional reputation. Ethical behavior contributes to the reputation of the accounting profession as a whole. Accountants who uphold ethical standards enhance the reputation of the profession and inspire confidence in their abilities. Principles of professional ethics. Professional ethics in accounting are guided by several key principles that help accountants navigate ethical dilemmas and make sound decisions. These principles include integrity. Accountants should be honest, truthful, and transparent in their professional activities. They should not engage in any form of dishonesty, fraud, or misrepresentation of financial information. Objectivity. Accountants should exercise professional judgment without bias or conflicts of interest. They should base their decisions on facts and evidence, ensuring that their professional judgment is not influenced by personal or financial interests. Professional competence and due care. Accountants should maintain a high level of professional competence and continually update their knowledge and skills. They should perform their duties with due care, ensuring that their work is accurate, reliable, and in compliance with professional standards. Confidentiality. Accountants should respect the confidentiality of client information. They should not disclose any confidential information without proper authorization, except in cases where disclosure is required by law. Professional behavior. Accountants should conduct themselves in a manner that upholds the reputation of the profession. They should avoid any behavior that could bring discredit to the accounting profession and should always act in the best interest of their clients and stakeholders. Professional skepticism. Accountants should maintain a questioning mindset and exercise professional skepticism. They should critically evaluate information, challenge assumptions, and verify the accuracy and completeness of financial data. Ethical challenges in accounting. Accountants often face ethical challenges in their professional practice. These challenges can arise from conflicts of interest, pressure to manipulate financial information, or the temptation to compromise ethical standards for personal gain. Some common ethical challenges in accounting include conflicts of interest. Accountants may face conflicts of interest when their personal or financial interests conflict with their professional responsibilities. For example, an accountant may be tempted to manipulate financial statements to benefit a client or their own financial interests. Pressure to manipulate financial information. Accountants may face pressure from clients, management, or colleagues to manipulate financial information to present a more favorable picture of the organization's financial performance. This pressure can compromise the integrity and accuracy of financial reporting. Ethical dilemmas. Accountants may encounter ethical dilemmas where they have to choose between conflicting ethical principles or face situations where there is no clear right or wrong answer. For example, an accountant may discover fraudulent activities within an organization and face the dilemma of whether to report it or remain silent. Whistleblowing. Accountants may find themselves in situations where they need to blow the whistle on unethical or fraudulent activities within an organization. Whistleblowing can be challenging as it may involve personal and professional risks, such as retaliation or damage to one's reputation. Ethical decision-making. To navigate ethical challenges, accountants should follow a structured approach to ethical decision-making. This approach involves identifying the ethical issue. Accountants should identify the ethical issue or dilemma they are facing. They should consider the potential impact on stakeholders and the ethical principles involved. Gathering information. Accountants should gather all relevant information related to the ethical issue. This may involve reviewing financial records, consulting with colleagues or superiors, and seeking legal or professional advice. Evaluating alternatives. Accountants should evaluate different alternatives and consider the potential consequences of each option. They should assess the ethical implications and determine the course of action that aligns with ethical principles. Making a decision. Accountants should make a decision based on their evaluation of the alternatives. The decision should prioritize ethical considerations and aim to uphold the integrity and credibility of financial reporting. Taking action. Accountants should implement the chosen course of action and monitor its effectiveness. They should document the decision-making process and maintain records for future reference. By following a structured approach to ethical decision-making, accountants can navigate ethical challenges with integrity and professionalism. In conclusion, professional ethics are of utmost importance in the field of accounting. Accountants must adhere to ethical principles to maintain the integrity and reliability of financial reporting. By upholding professional ethics, accountants contribute to the credibility of the profession and build trust with clients and stakeholders. Ethical decision-making and the ability to navigate ethical challenges are essential skills for accountants to ensure they act in the best interest of their clients and the public. 12.2 Conflicts of interest. In the world of accounting, conflicts of interest can arise in various situations and can have significant implications for the integrity and objectivity of financial reporting. A conflict of interest occurs when an individual or entity has competing interests that could potentially compromise their ability to act in the best interest of another party. In the context of accounting, conflicts of interest can arise between accountants, auditors, and their clients, as well as within accounting firms themselves. Nature of conflicts of interest in accounting. Conflicts of interest in accounting can manifest in several ways. One common scenario is when an accountant or auditor has a financial interest in the outcome of a client's financial statements or audit report. For example, if an accountant owns shares in a company they are auditing, their objectivity and independence may be compromised. Similarly, if an accounting firm provides consulting services to a client while also auditing their financial statements, there is a potential conflict of interest as the firm may be hesitant to report unfavorable findings that could jeopardize their consulting relationship. Another type of conflict of interest in accounting occurs when an accountant or auditor has personal relationships with individuals within the client organization. These relationships can create biases or pressures that may influence the accountant's judgment and compromise their objectivity. For instance, if an accountant is friends with a company's CEO, they may be more inclined to overlook irregularities or engage in unethical practices to maintain the relationship. Conflicts of interest can also arise within accounting firms themselves. For example, if a partner in a firm has a personal financial interest in a client's business, they may be tempted to prioritize their own financial gain over the best interests of the client. Additionally, conflicts can arise when a firm provides services to multiple clients in the same industry, potentially compromising the confidentiality and objectivity of the information shared between clients. Implications of conflicts of interest. Conflicts of interest in accounting can have serious consequences for financial reporting and the overall trust in the profession. When accountants or auditors are influenced by conflicting interests, the accuracy and reliability of financial statements may be compromised. This can lead to misleading information being presented to stakeholders, potentially resulting in financial losses, damaged reputations, and legal consequences. Conflicts of interest can also erode public trust in the accounting profession. If the public perceives that accountants are prioritizing their own interests or those of their clients over the public interest, it undermines the credibility and integrity of the profession as a whole. This can have far-reaching implications, as public trust is essential for the functioning of financial markets and the overall stability of the economy. Managing conflicts of interest. To maintain the integrity and objectivity of financial reporting, it is crucial for accountants and accounting firms to have robust conflict of interest policies and procedures in place. These policies should outline the steps to be taken to identify, assess, and manage conflicts of interest effectively. One key aspect of managing conflicts of interest is ensuring independence and objectivity in the audit process. This can be achieved by implementing rotation policies that require auditors to periodically rotate off engagements to prevent long-term relationships that could compromise independence. Additionally, accounting firms should establish clear guidelines on the provision of non-audit services to audit clients to avoid conflicts of interest. Transparency and disclosure are also essential in managing conflicts of interest. Accountants and accounting firms should disclose any potential conflicts of interest to their clients and relevant stakeholders. This allows for informed decision-making and helps to maintain trust and credibility. Ethical decision-making plays a vital role in managing conflicts of interest. Accountants should be guided by professional codes of ethics and exercise professional judgment to ensure that their actions are in the best interest of the public and their clients. This may involve seeking guidance from superiors, consulting with colleagues, or even recusing oneself from a particular engagement if a conflict of interest cannot be effectively managed. Conclusion. Conflicts of interest are a significant concern in the accounting profession as they can compromise the integrity and objectivity of financial reporting. Accountants and accounting firms must be vigilant in identifying and managing conflicts of interest to ensure the accuracy and reliability of financial information. By implementing robust conflict of interest policies, promoting independence and transparency, and adhering to ethical principles, accountants can uphold the trust and confidence that stakeholders place in the accounting profession. 12.3 Ethical Decision-Making. Ethics play a crucial role in the field of accounting. As professionals entrusted with financial information, accountants have a responsibility to act in an ethical manner and make decisions that are in the best interest of their clients, employers, and the public. Ethical decision-making involves considering the moral implications of various choices and selecting the course of action that aligns with ethical principles and values. Understanding ethical decision-making. Ethical decision-making in accounting involves a systematic process of evaluating different options and determining the most ethical course of action. It requires accountants to consider the potential consequences of their decisions and the impact they may have on various stakeholders. Here are some key steps involved in ethical decision-making. Identify the ethical dilemma. The first step in ethical decision-making is recognizing that there is an ethical dilemma. This may arise when there are conflicting interests, values, or principles at play. Accountants need to identify the specific ethical issue they are facing and understand the potential consequences of their actions. Gather relevant information. Once the ethical dilemma is identified, accountants should gather all the relevant information related to the situation. This includes understanding the facts, regulations, and ethical guidelines that apply to the specific scenario. It is important to have a comprehensive understanding of the context before making a decision. Identify alternative courses of action. In this step, accountants should brainstorm and identify different possible courses of action that could be taken to address the ethical dilemma. It is important to consider a range of options and evaluate their potential outcomes and implications. Evaluate the alternatives. After identifying the various courses of action, accountants need to evaluate each option based on ethical principles and values. This involves considering factors such as fairness, honesty, integrity, and the potential impact on stakeholders. Accountants should also consider any legal or professional obligations that may apply. Make a decision. Once the alternatives have been evaluated, accountants need to make a decision on the most ethical course of action. This decision should be based on a careful analysis of the potential consequences and the alignment with ethical principles. It is important to document the decision-making process and the rationale behind the chosen course of action. Implement the decision. After making a decision, accountants need to implement the chosen course of action. This may involve communicating the decision to relevant parties, taking necessary steps to execute the decision, and monitoring the outcomes. Reflect and learn. Ethical decision-making is an ongoing process, and it is important for accountants to reflect on their decisions and learn from their experiences. This allows for continuous improvement and the development of ethical decision-making skills. Ethical considerations in accounting. Accountants face a range of ethical considerations in their profession. Some of the key ethical issues that accountants may encounter include confidentiality. Accountants often have access to sensitive financial information, and maintaining client confidentiality is of utmost importance. They must ensure that they do not disclose any confidential information without proper authorization. Objectivity and independence. Accountants should maintain objectivity and independence in their work. They should not allow personal biases or conflicts of interest to influence their professional judgment. This includes avoiding any financial or personal relationships that may compromise their independence. Integrity and honesty. Accountants are expected to act with integrity and honesty in all their professional dealings. This includes being truthful and accurate in financial reporting, avoiding fraudulent activities, and adhering to ethical standards. Professional competence. Accountants have a responsibility to maintain their professional competence and stay updated with the latest accounting standards and regulations. They should only undertake tasks that they are qualified to perform and seek assistance or guidance when needed. Professional skepticism. Accountants should exercise professional skepticism and critically evaluate the information they receive. This involves questioning assumptions, verifying data, and conducting thorough analysis to ensure the accuracy and reliability of financial information. Responsibility to stakeholders. Accountants have a responsibility to act in the best interest of their clients, employers, and the public. They should consider the potential impact of their decisions on various stakeholders and make choices that promote transparency, accountability, and fairness. Ethical decision-making frameworks. To assist accountants in making ethical decisions, several frameworks and guidelines have been developed. These frameworks provide a structured approach to ethical decision-making and help accountants navigate complex ethical dilemmas. Some commonly used frameworks include utilitarianism. This framework focuses on maximizing overall happiness or utility for the greatest number of people. Accountants using this approach would consider the potential consequences of their actions and choose the course of action that produces the greatest overall benefit. Rights-based ethics. This framework emphasizes the protection of individual rights and freedoms. Accountants using this approach would consider the rights of all stakeholders involved and make decisions that respect and uphold those rights. Virtue ethics. This framework focuses on developing and practicing virtuous qualities such as honesty, integrity, and fairness. Accountants using this approach would consider the virtues and values that are important in their profession and make decisions that align with those virtues. Principle-based ethics. This framework involves applying ethical principles and guidelines to decision-making. Accountants using this approach would consider principles such as honesty, fairness, and responsibility and make decisions that adhere to these principles. It is important for accountants to familiarize themselves with these frameworks and use them as a guide when faced with ethical dilemmas. However, it is also essential to exercise professional judgment and consider the unique circumstances of each situation. Conclusion. Ethical decision-making is a critical aspect of accounting practice. Accountants must navigate complex ethical dilemmas and make choices that align with ethical principles and values. By following a systematic decision-making process, considering the potential consequences, and adhering to professional ethics, accountants can uphold the integrity of the accounting profession and contribute to the trust and confidence in financial reporting. 12.4 Corporate Social Responsibility. Corporate social responsibility, CSR, is a concept that has gained significant attention in recent years. It refers to the ethical and responsible behavior of businesses towards society and the environment. In the context of accounting, CSR involves the consideration of social and environmental impacts in financial reporting and decision-making processes. Understanding corporate social responsibility. CSR goes beyond the traditional focus of businesses solely on profit maximization. It recognizes that companies have a broader role to play in society and should take into account the interests of various stakeholders, including employees, customers, suppliers, communities, and the environment. The concept of CSR encompasses several key principles. Ethical conduct. Companies are expected to operate with integrity, honesty, and transparency. They should adhere to ethical standards and comply with applicable laws and regulations. Environmental sustainability. Businesses should strive to minimize their negative impact on the environment. This includes reducing carbon emissions, conserving resources, promoting renewable energy, and adopting sustainable practices throughout their operations. Social responsibility. Companies have a responsibility to contribute positively to society. This can involve supporting local communities, promoting diversity and inclusion, ensuring fair labor practices, and engaging in philanthropic activities. Stakeholder engagement. Businesses should actively engage with their stakeholders and consider their interests in decision-making processes. This includes listening to feedback, addressing concerns, and maintaining open lines of communication. The role of accounting in corporate social responsibility. Accounting plays a crucial role in promoting and measuring corporate social responsibility. It provides the tools and frameworks necessary to assess and report on the social and environmental impacts of business activities. Here are some ways in which accounting contributes to CSR. Sustainability reporting. Accounting frameworks, such as the Global Reporting Initiative (GRI) and the Sustainability Accounting Standards Board (SASB), provide guidelines for reporting on environmental, social, and governance (ESG) performance. These frameworks help companies disclose their CSR initiatives and their progress towards sustainability goals. Triple bottom line reporting. Traditional financial reporting focuses on the financial performance of a company. However, CSR requires a broader perspective. Triple bottom line reporting incorporates financial, social, and environmental aspects, providing a more comprehensive view of a company's overall performance. Cost-benefit analysis. Accounting techniques, such as cost-benefit analysis, can help companies evaluate the financial implications of CSR initiatives. By quantifying the costs and benefits associated with social and environmental actions, businesses can make informed decisions and prioritize their CSR efforts. Internal controls and compliance. Accounting systems and internal controls ensure that companies comply with relevant laws and regulations related to CSR. This includes monitoring and reporting on issues such as labor practices, product safety, and environmental compliance. Benefits of corporate social responsibility. Adopting CSR practices can bring several benefits to businesses, including enhanced reputation. Companies that demonstrate a commitment to CSR are often viewed more favorably by customers, investors, and the public. A positive reputation can lead to increased customer loyalty, improved brand image, and a competitive advantage in the market. Risk management. By considering social and environmental factors, businesses can identify and mitigate potential risks. This includes avoiding legal and regulatory penalties, minimizing reputational damage, and anticipating changes in consumer preferences. Employee engagement. CSR initiatives can boost employee morale and engagement. When employees feel that their company is making a positive impact, they are more likely to be motivated, productive, and loyal. Access to capital. Investors are increasingly considering ESG factors when making investment decisions. Companies with strong CSR practices may have better access to capital and attract socially responsible investors. Long-term sustainability. By integrating CSR into their business strategies, companies can contribute to the long-term sustainability of their operations and the communities in which they operate. This includes reducing environmental risks, fostering social development, and promoting economic stability. Challenges and criticisms of corporate social responsibility. While CSR has gained widespread recognition, it is not without its challenges and criticisms. Some common concerns include greenwashing. Some companies engage in greenwashing, which involves making false or exaggerated claims about their environmental or social performance. This can mislead stakeholders and undermine the credibility of CSR initiatives. Lack of standardization. There is currently no universally accepted framework for CSR reporting, leading to inconsistencies in how companies disclose their CSR activities. This makes it difficult for stakeholders to compare and evaluate the performance of different companies. Trade-offs with profitability. Critics argue that CSR initiatives may come at the expense of profitability. They contend that businesses should focus solely on maximizing shareholder value and that CSR activities should be voluntary rather than mandatory. Complexity and measurement challenges. Measuring the social and environmental impacts of business activities can be complex and subjective. Quantifying the financial value of CSR initiatives and their impact on long-term sustainability is often challenging. Despite these challenges, the importance of CSR in accounting and business cannot be ignored. As stakeholders increasingly demand transparency and accountability, companies must integrate CSR into their strategies to ensure long-term success and contribute positively to society and the environment.